Okay, well, I have your names. This is Celine. Carol. I'm Paula. So I've been with Primerica. This is my 36th year with Primerica. So before y'all were born, right? But I was one of the first instructors ever in Southern California and helped write the first book. I've been around a long while. So feel free to take notes, ask questions. If I ask you questions, answer out loud, please. Okay? So we're just going to get right into it. So we're going to look at the terms, because if you learn the terminology, you know what the words mean, it makes it a lot easier, right? So, but when you go take the test, you're not going to have to think too much because you have my cheat sheets, right? So, all right. So we're looking at the application, underwriting, and policy delivery. Okay, so the insurer is a company that sells insurance policies or contracts, also called an insurance company. We work for Primerica. They're our insurer, right? The insured is a person, a client, right, protected by the insurance company. I always say insurer or insured, so you guys will learn to look for that when you're taking the test, so you know who they're talking about, right? The policy owner has all the rights. What does the policy owner have? All the rights. So they get to decide what to do with the policy, who's on it, for how much, for how long, everything. If they want to change it, they can. The owner has all the rights to the policy. They may or may not be the insured. So you could buy a policy for somebody in your family, blood related, that's dependent on you, right? Your child is the usual one, or a spouse, and you be paying the premiums. The applicant is the person completing the application. Usually that's the insured. The beneficiary is the person's receiving the face value of the policy in case of the insured's death. So the beneficiary doesn't have to have any insurable interest. You can name anybody or anything your beneficiary, right? Let's see if it'll change. That help? The certificate of authority, the license from the State Department of Insurance that allows an insurer to do business in that state. You have to have a certificate of authority to come in the state to do business. So Primerica has a certificate of authority in all the states in which we do business, and in Canada, Guam, Puerto Rico, all the provinces, right? Admitted or authorized insurer is an insurer who has received that certificate of authority to do business in a state. So you're likely to get both of these in the test. Certificate of authority you got to have, and if you have that, you are then admitted. A non-admitted or unauthorized insurer is an insurer who has not been approved to conduct business in a state. Therefore, you're not going to do business with them, right? A mutual insurer is an insurer that is owned and controlled by its policy owners. Mutual insurers issue participating policies, which pay dividends back to the policy owners. So mutual, participating, and dividends all go together. Dividends are a return of excess premium. What are they? Yeah, they charge you too much to start with, right? So dividends are not guaranteed. So they usually don't pay them until after at least the first 3 to 5 years. And then if they can justify spending all of the money, they don't have to pay them. So they're not guaranteed. Stock insurer, an insurer owned by its stockholders who buy shares of the company. They sell non-participating policies. They do not pay dividends. Stockholders control the company and they elect a board of directors. Fraternals, anytime you see for its members, they're talking about fraternals. So they're a fraternal benefit society that's nonprofit benevolent organizations based on a lodge system with a representative form of government that provides insurance only to their members, right? Members and fraternal go together. It's like the Elks, you know, or the Moose, whatever. Those are fraternals. A domestic insurer is an insurer who does business in the state in which it is incorporated. So Primerica would be domestic to what state? No, our home office is in Georgia. So they are domestic in Georgia and foreign everywhere else in our country. In Canada, they would be alien. Simple, right? Foreign, domestic, alien. So domestic in the state in which they're incorporated, foreign in any other state, alien in any other country.
Georgia, foreign
foreign state. foreign states. No, not in the country, but only for insurers. They're considered foreign if they're in another state. Crazy, huh? Yeah. So that's why we want to make sure you understand. It doesn't mean they're in another country, just another state. Alien is another country, whereas to us, alien is another world, right? So there you go. Producers, that's what you are learning to be right now, a producer, an individual who sells insurance for a particular company and has a contract with that company, right? That's another word for agent. Same thing, right? Yeah. Producers represent the insurer. Who does the producer represent? The insurer in insurance transactions. A producer acts as a fiduciary, a person in position of trust and confidence. When you see the word fiduciary on the test, look for the word premium. Producer, fiduciary, premium, they all go together, right? So, what are you going to look for if you see fiduciary? Yes, premium is the main one. Because the producer accepts premium payments on behalf of the insurer and offers advice on financial matters. So when you accept premium, if you actually get a check from somebody, can you just go put that in your bank account? Not a chance, right? I mean, chances you guys getting the check ever these days probably really small because everything's electronic. But just in case, you know, if you go to that family's house that doesn't want to do things electronically, they don't seem to get, you know, this is going to go electronic as soon as you leave their house, right? But you're going to put it right in your computer. But yeah, if you have to do a paper app and take a check, then, you know, it goes straight to your RVP office, right? Underwriting is the selection, classification, and rating of risk. Underwriting selects and classifies. What does underwriting do? Insurable interest, the requirement that the policy owner must face the possibility of losing something of value if the insured dies, such as income, home, or money. A person must have a financial interest in the life of the applicant when purchasing a policy. See, it says when purchasing, so that's at the time of application. So in my first marriage, which was like, you know, a million years ago, father of my children, we had a life insurance policy, and the court ordered when we split that he continue to pay that policy until our children were adults. So if I wanted to continue that policy when my children reached the age of adulthood, I could continue to pay it and keep that policy, because when we purchased it, we had insurable interest. If I let it go and I want to do it now, 40 years later, not a chance, right? No insurable interest. So, make sense? Okay. So insurable interest must exist when? At the time of application. You say it out loud, really loud, it helps it stick in your head. Insurable interest must exist at the time of application. The elements of a legal contract. I don't like the way I have it in here. I should have changed it, but I didn't get there yet. I like it to do CLAC. So I do consideration first, okay? Consideration is exchange of value. If the insured pays the premiums, the insurer then promises to pay the benefit in the event of a loss. So consideration is premium for a promise. What is consideration? Okay, then L is legal purpose. Legal purpose must be legal and not against public policy. The insurance policies must have both insurable interest and consent. So if you see insurable interest and consent or a contract, they're looking for legal. Okay. Then I use agreement. So CLA, right? And then the next one would be C, and it'd be CLAC. Easy to remember, CLAC. So the agreement, or the offer and acceptance, this is actually two test questions right there in the offer and acceptance. The offer is the submitted application, and the acceptance is when the underwriter approves and issues the policy. So two questions done there, right? Easy. And then the final C is competent parties. You must be of legal age, mentally competent to understand the contract, and not under the influence of drugs or alcohol. So to be a competent party, you can't be Mimi. Mimi. Mimi is, you can't be a minor. You cannot be intoxicated. So if you're going to your friend's house and to show them what we do, and they're like to have a cocktail after work or a beer, you know, or maybe even light up, not okay. right? You cannot do business. So if they do that, just say, please, can you wait until after we do our appointment, right? So otherwise they can say, hey man, I was drinking, I didn't know what I was doing, right? You can sell it the same day you meet, but they can't be drinking or, getting high or something like that. Right. That's very important, right? So you can't be a minor, you can't be intoxicated, you can't be mentally incompetent. I take care of my younger brother. He's 13 months younger than I am. In fact, Selena actually helps me with him. But he has schizophrenia. And so he's not allowed to sign a legal contract ever. If he talks somebody into selling him a car, no, too bad. He's not responsible for it, right? Mentally incompetent, can't sign a contract. So same thing with life insurance, right? Distinct characteristics. Let's see, we have a contract of adhesion. You see, take it or leave it, it's adhesion, right? If you see accepted or rejected, sometimes they don't put the take it or leave it, then you still know it's adhesion, right? So it's prepared by one party and accepted or rejected by the other on a take it or leave it contract offered by the insurer with no negotiation. You don't get to choose what's in your contract, right? You get to choose your dollar amount and your time period, and that's pretty much it, right? Excuse me, aleatory. An exchange of unequal values. The premium amount paid is smaller than the amount the insurer will pay in the event of a loss. I always share my story of my very first contract I wrote on my own pen. I used to be a school teacher, and one of the gals I worked with, a fellow teacher, and we also taught a Sunday school class together. She had $30,000 worth of coverage on her husband only. She paid $72 a month for it. I went in and put $250,000 on him, $250,000 on her, $10,000 on each of their children. They had 4, and only $30 a month. Does that make a difference? Pardon? Yeah. Yeah. Well, things changed over the years, right? This was 1988. But when I wrote that policy on her, it was on paper because we didn't yet have computers in 1988. That's how much life has changed, right? But I had just mailed the policy off, and just a couple hours later, she called me up and told me that her husband had been killed in an accident. The company didn't even have the application yet. So I called them up and I said, well, I sent the application off just a few hours ago. And they said, well, do you have a copy of it? And I said, sure, can you fax it in? Okay, I faxed it in. They said, well, we'll go ahead and do an autopsy at our expense as long as she's okay with that. And if he was found to be insurable, we pay the claim. So for one $30 premium, she got $250,000. Yeah, that's aleatory, right? Pay a little, get a lot. It's a big deal. Oh. Unilateral means only one party is legally bound to do anything. The insured makes no binding promise, but the insurer is legally bound to pay the losses covered by the policy. So you can get out of it by not paying, right? But if you get the unilateral question, it usually uses the word one in the question. So that makes it easy, right? Conditional. Certain conditions must be met for the contract to be executed. The insured must pay the premiums and provide proof of loss for the death benefit to be paid. On the conditional question, there's usually the word if somewhere in that question. If you see the word if, they're looking for conditional, because if means condition, right? If you do this, we'll do that, right? So this, if you guys want to take screenshots, you're welcome to do that. A warranty is an absolute true statement. It's the same as a guarantee, right? A breach of a warranty could void the policy. A representation are statements that are true to the best of the applicant's knowledge. So let's say you asked all the medical questions of your client and they said, oh no, we're fine, nothing happened. And then they do a medical and it shows up, oh, they did have a little heart condition. They just didn't know about it. So it's okay. It's not a lie. It's true to the best of their knowledge, right? It's not guaranteed to be true. The answers on the insurance application are representations. Come on. So the parts of the application, there's part 1 and part 2. Part 1 is general, has your basic information, your name, your address, your occupation, that kind of stuff. And part 2 is the medical. So if you get a question that asks you about where they're going to find out about a person's deceased relatives or their height and weight, you know, that's going to be in part 2, the medical, right? Part 1 is just general. So then there's the agent's report. So let's say you go to a client's home, coming in. All right, just come in and sit down. If you go to a client's home and say their garage is open and you see all kinds of motorcycles, Sea-Doos, you know, just fun toys, things to play with. And then you're asking them their questionnaire, are they doing anything hazardous, like sports, hobbies, occupations, whatever? They say, oh, no. Then you got to put a little note in your agent's report after you leave there. They never see it. It doesn't become part of the application, but the home office will see it and they'll send somebody to check it all out and make sure. You don't have to say, well, who's doing all that, right? That's not our job. So the required signatures on the application must be signed by the agent, the proposed insured, and the policy owner if it's different than the insured, not the underwriter. So they'll say, oh, we'll follow except, right? The underwriter is what doesn't belong. The changes on the application, if you're doing a paper application, you can never erase. That's not allowed, okay? But like I said, chances of you doing a paper app are pretty slim. So you either have the applicant initial or change or complete a new application. You never erase or never use whiteout. But, you know, on electronic, you can just delete, do it over, right? So makes it better. Incomplete applications will be returned by the underwriting department to be completed. So if you're doing a paper application, there's a lot of forms that go with it. I used to forget them a lot, but that's how I built relationships with my clients. Because I mean, there's so many different things, right? How could I was new. I had nobody training me really. I trained myself and I just had to learn it. So if I'd forget something, I just go pick up a cheesecake or make some cookies or something and I go visit my people. I always take food when I go on an appointment every time, right? Because you build relationships over food, right? And I've never had a chargeback in almost 36 years, ever. Yeah. So collecting the premium, the information sources, when you collect the premium, if you collect premium at the time of application, then a conditional receipt is usually given, which makes the coverage effective as the date of application. Here's a question for you, test question. Effective as of the date of application or the date of the medical exam, whichever is later. That's an answer right there. If the company issues the policy as it's applied for, right? So whichever is later is what you'll be looking for. Medical information for policies with higher coverage amounts. Underwriters may request a paramedical report on an attending physician's report. Medical examinations, any required medical exams are conducted at the insurer's expense. And a paramed report would be completed by a paramedical or a registered nurse, usually at the client's home. Medical Information Bureau, nonprofit trade organization, which collects adverse medical information from member insurance companies as a way of sharing and comparing, excuse me, medical information on applicants, and it goes right to this central place. So like if you were here in California and were diagnosed with cancer and you didn't have life insurance and you thought, well, I'll just jump over to Arizona or Nevada and get some real quick, right? It won't work because they already know it's in their system, right? So that's the MIB, and they are a nonprofit and supported by member insurers. Okay. HIV testing and consent. The insurer must inform the applicant of the HIV test and obtain written consent for the test. The insurer must have procedures in place for the internal dissemination of test results to ensure confidentiality. So they don't send it to the Department of Insurance, right? So they'll do all the following except they're not going to send it to the Department of Insurance. That's your personal information, right? HIPAA is federal law that protects health information. Under the HIPAA privacy rule, patients have the right to view their own medical records and know who has accessed their records. In the Fair Credit Reporting Act, federal law protects consumers against the circulation of inaccurate or obsolete information. So what does the Fair Credit Reporting Act do? It protects consumers, right? Inspection reports. Reports are collected by an independent investigating firm or credit agency about a consumer's finances, character, work, hobbies, and habits. Investigative consumers reports are similar to consumer reports, but they include interviews about the consumer with associates, friends, and neighbors. So they can send somebody out to your neighborhood and start talking to people, or to your work, right? Usually they do that if you're asking for a really large amount of coverage and they want to know why you need it, right? So replacement is when existing policy is terminated or allowed to lapse and a new one is purchased in its place. And special underwriting concerns might happen to make certain that replacement is in the best interest of the client. So if you get a replacement question, usually if replacement is in the question, replacement is in the answer. So when you go and take your exam, you're not going to be spending a whole lot of time reading questions, right? Questions are designed to confuse you. I want you to learn the answers, how to pass the exam the first time, right? So risks that are acceptable to an insurer or company are placed in groups. They're classified by the underwriter. The risks are standard, substandard, and preferred. Most everybody, you're going to write standard, right? Standard is good. So if they accept what we give them at a standard rate, and then the company finds them to be preferred, they're going to be really happy. They got a lower rate, and they're going to go tell all their friends, right? There you go. If they're substandard, you're going to know. If they're a smoker, they're automatically substandard, right? They're going to pay almost double the premium. If they take generally 2 medications, I mean, I would never tell anybody that we can't cover them, because they do take everybody on an individual basis. They really do. And sometimes they might say, well, we won't pay if this. I mean, I had a little girl who wasn't mine by birth, but she lived with me for 3 years. And when she had to go back to her parents, they starved her to death inside of 6 months. It was horrifying. But because she was mine for 3 years, somebody in my office called the home office and said, hey, what about this? And they sent me a check. Yeah. I was like, dang, okay. I gave her a really nice funeral. So, yeah. Yep. 15. 42 pounds when she died. Yeah. It was horrifying. Anyway, if the risk is too great, the company will decline the risk. I've had one client declined in 36 years. Only one. So try to, ask questions before you start writing people up, right? But never tell them no. Always submit an app. So stranger originated life insurance, a STOLI, is an arrangement in which someone with no relationship to the insured, a stranger, purchases a new policy on the insured's life and then sells the policy to an investor in order to profit financially when the insured dies for the life sum. That's not legal. Okay, but people still try to do it all the time. They'll go say, oh, I was just telling them, you're my grandma, right? They do that. And they say, we'll pay all your final expenses and your family won't have to worry. So they might, pay $2,000 and have them cremated, and they take the rest of the money. That happens. Investor originated life insurance, an IOLI, is another name for a STOLI, where an investor initiates the purchase of the policy and the ownership of the policy is then transferred to someone with no insurable interest in the insured, with hopes of profiting upon the death of the insured. Such a deal, huh? So both STOLIs and IOLIs violate the principle of insurable interest. Remember, we talked about earlier. Come on. I hate technology so much. It won't go. Daniel, I wish you were here.
You want me to call somebody?
No, it'll go in a minute. Maybe it needs this okay. I don't know. There has to be an arrow, right? There, I found the arrow. It's good. Okay, the agent should deliver the policy and review the policy coverage and explain any changes or ratings, explain provisions, riders, and exclusions, discuss when coverage begins, collect the premium if it was not submitted with the application, and if necessary, obtain a statement of good health. So just a minute ago, I just saw it say start video. I don't know if it was on for the recording. Oh, well, we do what we can do, right? We explain the provisions, riders, and exclusions. This is where everybody messes up. The provisions, riders, and exclusions. It's not a difficult thing. You just have to learn it, right? So you got to discuss when the coverage begins. Collect the premium if it was not submitted with the application, and if necessary, obtain a statement of good health. So the thing you collect, if you're delivering the premium and they haven't paid their first premium yet, you got to collect the premium with a statement of good health, saying nothing bad has happened to them. And they might have to have that from a doctor, right? Gotta love technology, right? The USA Patriot Act, anti-money laundering. In response to the 9/11 terrorist attacks, the USA Patriot Act was passed to fight and prevent terrorist activities. It requires banks and financial institutions, including insurers, to establish anti-money laundering standards and report any suspicious activity. Somebody very prominent in our country, they found 170 suspicious activity reports on them last week. Suspicious activity reports, or SARs, are procedures and plans that must be in place to deal with any suspicious activity such as money laundering or terrorism financing. Deposits involving 5,000 or more must be reported if the activity is suspicious. So when you go to the bank, if you're doing more than 5,000 a month, they're going to be wanting to know where the money's coming from. I encounter that pretty often.
How would that apply to the insurance? So where it says suspicious activity reported by insurers who will buy different policies under this thing?
Yeah, you can buy like fat amounts of insurance to try to hide money, right? People used to do that a lot. So then they came up with this thing called a modified endowment contract. And if it doesn't meet the 7-pay test, then it's no longer insurance. It's an investment. And so they're just going to track our money no matter what, right? But that's really what it comes down to, is where's the money coming from? So we want to make sure we're not hiding it. We're paying taxes, right? That's really what it's about, is taxes. So the process of issuing a policy. This is going to be a little diagram. Y'all can take a picture of it if you want. Issuing an insurance policy, you complete the application, collect the premium, send the application. The company underwriting and looks at the insurable interest, and they review the sources, and they look at the risk selection. Then on issue and delivery, you go and you explain the coverage and the charges and collect the statement of good health if they didn't pay their premium on when you took out the application, and go through the policy summary with them, make sure everything is right, that the names are right, they're spelled correctly, the birth dates are right, the dollar amounts are right. That's your job to do, right? Every appointment I've ever been on, their other agent never did that with them. I've had one client in 36 years ever even open their policy. Usually it's in the closet. They bring me out their illustration, right? This is not the policy. This is an illustration. See right here, it says, this is an illustration for hypothetical purposes only. It's not your contract, right?
And he was paid.
Huh?
He was paid.
Oh yeah, they were paid. Yeah. They paid for years.
So they
That was
send
not the contract.
you a copy of your contract.
Yes.
And then a copy of what else?
That's it. The contract is the policy, right? So, and then as soon as you do that and you have them sign that delivery receipt, then their free look period begins. Free look period is how long? 10
days for 30 days for senior, 10 days for.
Correct. It's also 30 days on replacement. Yeah. So, but free look is for the test, 10 days, right? Here's a quiz, everybody. So underwriting is a process of what? Selection and issue of policies, valuation and classification of risk, or selection, reporting, and rejection of risk, or risk selection and classification. Risk selection and classification. What does underwriting do? Select and classify, right? A statement that is the absolute truth is what?
Minutes for
No,
Fraud.
it's a warranty. Warranty is guaranteed to be true, right? A warranty is like a guarantee. So there's your warranty. This document says that the coverage will be effective either on the date of the application or the date of the medical exam, whichever occurs last. What is that? Good job. Conditional receipt. Which of the following risk classifications would pay the lowest premium? Preferred, standard, substandard, or declined? Good job. Yes. Preferred is the lowest. Which of the following statements describes an insurable interest? The policy owner must expect to benefit from the insured's death. The policy owner must expect to suffer a loss when the insured dies, or the beneficiary by definition has an insurable interest in the insured, or the insured must have a personal or business relationship with the beneficiary.
The policy owner is B.
B. B. The policy owner must expect to suffer a loss if the insured dies. That's insurable interest, right? So if you're going to lose their income, you're suffering a loss, right? The statements made by an applicant on an application for life insurance are considered to be so representations is the correct answer there.
A lot of these don't come out in the test though.
Oh, yes, they do.
They do because I did it yesterday
Yeah,
and I didn't, like the ones that I studied for.
yeah.
ones that I was
You didn't
studying,
get those?
I didn't really do those, but I did. I got a practice test, I was getting a 68%.
Mhm.
So I came confident enough, right?
Mhm.
And then once I was here, I got a like 25%.
Oh, wow. Yeah, well,
So
this
it was
should
like
fix that. Yeah, it happens. It happens, but if you learn the answers are always the same. The questions are designed to confuse you, right? So you read the answers first, always. If you think you know the answers, mark it. Right?
Yeah.
Okay. In the formation of a legal contract, each party must give something of value. Under contract law, this is referred to as something of value. Is what? Consideration, something of value. Yes. One of the main purposes of the USA Patriot Act was to establish a new standards for banks, broker-dealers, and other financial institutions. What were they doing it for? Anti-money laundering is it. So if you see any money laundering, you know, it's just the answer. You don't have to read the question, right? Easy. An insurance contract must contain all the following elements to be considered legally binding, except offer acceptance, competent parties, beneficiaries' consent, or consideration. Exactly. A beneficiary doesn't have to have consent. You don't even have to tell them they're a beneficiary if you don't want to, right? That's right. As a field underwriter, an agent has all the following responsibilities except what? Solicit business, help prevent adverse selection, obtain appropriate signatures on the application, or issue the policy. What do we not do you think? C.
No, B.
Actually, it's D. We don't issue the policy. The company does, right? Yeah. Like, I know, that's what I said. Yeah, we don't issue the policy, the company does. We deliver it, right? Okay, that was 2 hours worth already. See? Didn't take long at all, right? So now we're going to talk about the types of policies. We have term life, traditional whole life, interest market sensitive, adjustable life, combination plans, and variations. People get confused about these a lot, but if you practice it enough, you'll figure it out. There's just some simple things to learn. So let's look at term insurance. Term insurance is plain, pure protection, no cash value, right? It's the most coverage for the least money. the premium usually stays level, right? The face amount can change, depends what kind you buy. If you buy level term, it stays the same, right? But if you get decreasing term, the face amount will go down. If you get increasing term, the face amount will go up. That's simple. That's term insurance. That's how complicated it is, right? It's the whole life that gets really nasty, right? Because they just try to come up with all kinds of different things to try and compete with us. So I just talked about all those things. So there's no cash value in term. The policy expires at the end of the term. So it's temporary insurance because you don't really need it for your whole life. But if you want to keep it, you can, right? Till like age 95 now. It provides the highest amount of protection at the lowest cost. Now, this is code. This isn't us just saying that because we sell term insurance, right? This is fact. You get the most coverage for the least money. Isn't that what people want? Most everybody, right? A term policy only matures if the insured dies during the contract period. So if you have a 25-year term and you die within that 25 years, it's going to pay. If you die after the 25 years, it's all gone, right? Unless you renewed it. If the insured dies after the contract period, there's no death benefit. That's simple. So hopefully you've written their investment so they don't need insurance any longer, right? That's really important that we buy term and invest the difference. Level term is called level term because the premiums and the face amount, the death benefit, stay the same for the length of the term. Increasing term, the face amount or the death benefit goes up according to a schedule set in the policy, such as every 5 years. Premiums remain level. So they factor it in. So the premiums are going to probably be kind of high, right? Because the face amount is going to increase. Excuse me. It's often attached as a rider to add additional coverage, such as a return of premium or cost of living rider. So if you go to your client's home and you're talking to them about term insurance, say, oh yeah, we have term, but we get all our money back at the end of the term. Do you guys have that? And you say, oh, sure, we could write you that if you like paying for insurance on your insurance. And they're gonna go, huh? I say, just bring me your policy and show it to them. And so I'll take out their policy and I'll look at their increasing term rider or return a premium rider, is increasing term, right? And it shows you in there how much it costs. So you open up your little Primerica app and you get the financial calculator and you figure out how much they're paying for it and how much it would be at 9% if they were investing that money instead of paying for insurance on their insurance. It's a slam dunk. That means you just sold them their insurance and their investment without even trying, right? I love that. Decreasing term, the face amount or the death benefit goes down over the time according to a schedule that is explained in the policy. The premium payments remain level. So you're going to pay the same amount for it during the whole time, but the face amount is going to start decreasing with the amount of debt. So debt and decreasing term go together, right? A mortgage is debt. So you see mortgage, you know, you're looking for decreasing term. You see debt, you're looking for decreasing term. But it's most often used to cover a debt that has an amount due that decreases over time, like a mortgage or a loan. So it tells you right there. Return a premium. So the policy pays the death benefit plus returns the premium paid if death occurs within a specified term, and they use increasing term for that, right? Annual renewable term. That's the purest form of term insurance, is annual renewable term. It renews each year without the insured having to provide insurability. So you don't have to go get a new medical every year. They'll just renew it every year, but it's going to cost more. So it's going to be the cheapest the first year, but by the 5th year, we're probably going to beat it, right? So it's good to look at their guaranteed premium rates in the policy when you're doing them. And you can just see, well, in 5 years, it's going to cost you this much. In 10 years, it's going to cost you this much. In 20 years, it's going to cost you this much. They're going to want you to dump it right then, right? So it renews each year without having to prove insurability. The premiums go up each year because the insured turns a year older. That's called attained age. Each year you attained a new age, right? Whoever thought I'd attained 70 already? Holy cow. I was 34 when I started this. A renewable term policy may be renewed at the end of the term without proving insurability. The number of renewals may be limited, or it may stop at a specified age. So the premium will be based on the insured's attained age. So that's a good thing to look for too if somebody has annual renewable term. How long can they keep renewing? What if it stops at age 35 and they need it to go until they're 50? Right? That would be important. Some term policies are not renewable and a new policy must be taken out at the end of the term. That means they have to have a new medical. How many know a lot can happen to you over a 10-year term? My own daughter, she at 21, I mean, I insured her as a kid. I mean, when I started this business, she was like 12 or 14, something like that. But I had her on my policy, so she was guaranteed renewable. At 21, she was diagnosed with tachycardia, heart rhythm thing.
Wow.
Yeah. She wouldn't have been insurable at all. And then when she was 32, I think, she had stage 4 colon cancer. Yeah. No, she's fine now. She's good. Thank you. But, you know, she would not be insurable at all. And the little dummy, I had her all set up to have her mortgage and everything all paid off, right? And she went out and decided she wanted to remodel her kitchen. So she took out a 30 grand loan on her house without telling me.
Oh my
Yeah,
God.
I could have written her a stupid check. You know, if she said, "Hey, Mom, what do you think?" You know, she didn't. No, she just went off. But so she had to renew her life insurance because she still had a mortgage. She's the only client I ever had needed to actually renew her life insurance. And so she shocked me. She shocked me. I'm like, what? Found out we're the best. We're the best. Nobody else would even touch her. I mean, she had cancer, she had a heart problem. You know, they're not going to touch her. They fixed her heart though, and we got rid of the cancer. She's perfectly fine. But crazy things happen, right? You just never know. So convertible term policy can be converted from temporary term to permanent coverage without proving insurability, but the premium will be based on your attained age. So if you bought your insurance when you're 20 and you're wanting to switch over to permanent when you're 35, it's going to be a lot more expensive, right? So. On whole life characteristics, here we go. Ordinary straight life is the same as whole life. It's the same thing. Single premium means you're going to pay with it only one time. So you might have cashed out an annuity or got an inheritance, or, you know, you got a lump sum of money. Maybe you won the lottery even, who knows? So you're going to buy your life insurance and pay for it just one time, be done. So in whole life, that will create immediate cash value. So you can start borrowing from it. So why do you want to borrow your own money? I don't know, but it's something you could do, right? They'll charge you 8% to borrow your own money. Such a great deal. Limited pay means you're going to pay for it for a shorter period of time. You don't want to pay for your insurance till you're age 100, right? You don't want to be paying for your insurance when you're retired, do you? That's how they sell this, right? So we'll just make the premium a few dollars higher and you can have it paid for by the time you're 65, or you can just pay for it in 20 years if you prefer, right? So it's called 20 pay or pay it up at 65. It's still good till you're age 100, but your payments stop either after 20 years or at age 65, depending on which type you bought. Sound like a good deal? No, no. Why are you going to pay more, right? Let them keep your money for longer. Not a good deal. Buy term, invest the difference, right? My investments right now are over 20 mil. Yeah, being in business for 36 years. Art Williams, he was just a godsend to me. I met him only 6 weeks in the business, and he said, "Paula, how are you doing?" I'm like, "I'm doing good. I'm a division." You know, it's like, "How long you been in business?" I'm like, 6 weeks. He said, "And you're a division?" I'm like, "Yeah, I was division when I got my license." He said, "Great." He said, "So tell me, you saving any money?" I'm like, "Yeah." He says, "How much are you saving?" I said, $25 a month. I'm all excited, right? I'm saving it all. And he says, $25. Yeah, Paula, how much do you make when you go out on a sale? I'm like, "Oh, at least like 300. And he says, "And how long does it take you to do that?" And I said, "Like an hour or two." And he says, "Are you used to making that kind of money?" I'm like, "No, sir." He says, "Save half." I'm like, "Half? I'm a single Mom, he said, save half. I promise you, you'll never regret it. You promise you'll save half? I'm like, yeah. He said, good, then come with me. And he took me down in the locker room. We were at the Forum where the Lakers used to play back in the 80s, right? And he introduced me to this little old man named John. And this little old man named John, he, Art says, Paula, this is John. John, this is Paula. You teach this little girl how to save money the right way? And he left me. Uh-oh, somebody in Virginia. Hello? Yes. From where? Oh, I'm teaching a class right at the moment. So can I call you this afternoon? Oh, you need a link? I'll send it to you. Sorry, I didn't say that. Anyways, can you find the text from Carolina on there and then send it to the one number that just you're good with that kind of stuff? Thank you. Anyways, huh? Oh, 019 955. How to think. Anyways, so he introduced me to this little man named John, right? And John's kind of old looking, and he looks at me and says, okay, Paula, if you're saving my money, where would you put it? And I looked at him and I said, in a balanced fund. And he looks at me and says, that's kind of crap they're teaching you. I'm like, yeah. He says, because I'm old, right? And I'm like, well, and he says, guess where I keep my money? And I'm like, no idea. And he said, 98% of my investments are in foreign, aggressive, and emerging markets funds. I'm like, what? I didn't even know what those were. I'm 6 weeks in a business, right? And he says, yeah. He says, do you know why? And I said, no. And he said, well, because even since 1929, and yes, I'm that old, he said, I made minimally 20%. Usually I make over 50. I went, what? I was told you could only get 12. He said, I'll teach you. So this was 1988. We didn't have these little computers like we have right now, right? We didn't have cell phones. They didn't exist. A cell phone was like a shoebox size thing rich people kept in their cars. It was crazy how quickly it changed, because like 1989 and 90, we had everything, right? So John, who it turns out was Sir John Templeton, the father of mutual funds, he says, give me your information. I gave him my information. He says, I'm going to call you in 3 years, but for the next 3 years, you're going to invest with George here. And he introduced me to George. George was before Bill Gates and Steve Jobs. He was the founder of GT Global Telecommunications. My first year investing with George, I earned 103%. You know the rule of 72? Yeah, my money more than doubled my first year. Almost doubled and a half. And then my second year, I got 56%. My third year, I got 38%. And then Sir John called me up at the end of the third year and put me in some Brazilian and South Korean funds that have consistently paid me over 50%. My money doubles, if not every year, then every other year. And that's how I have $20 million. I have actually a lot more than that. That's just my mutual fund. I have foreign currency that's going to far exceed any of that. If we have a currency change, which it looks like it's changing this next week, I'll have over 300 trillion.
And when
in 1988. And I've consistently saved half of everything I earned. 36 years. Yeah. Yeah. From day one. Yeah. So, I mean, the day I got my license, I started my mutual fund. So you want to make sure you start your investments, right? So it's well worth it, trust me. So, I mean, I have 2 oil properties. I have 20 acres up in Northern California. I have a lot of stuff, a lot. And to be able,
how did you like all that being a single parent? Because I'm a single mother too.
Are you kidding? I used to stand in Salvation Army lines to feed my children. I was that poor. And I started doing this business only 2 hours a week because I was working 3 jobs, 18 hours a day. I just didn't have time. I had, as a manager, to schedule myself 2 hours off to do this business. And I would set 5 appointments for those 2 hours. So I'd have to get other people even to run appointments for me, but they still let me sign them. And, shared them, but I didn't care. But I earned enough inside of 6 months, working 2 hours a week to buy a new car for cash. So, yeah. So it changed my life entirely. I mean, I used to have to push my car to start it. It depends how much you write. Yeah. And if you get out and recruit yourself a team, you know, I started out with 9 people on my team. So I was making 60% commissions. I never did the 25%. That just didn't make sense to me. Why would I get paid 25% if I can go make 60% right out the gate? Right. So you had to get your securities license to go regional at that point to be a regional leader. So I got my securities license pretty quickly. But yeah, it's so important what we do. We change people's lives. We really do. It's really sure. Well, it's okay. Next. Next.
No, bro, we don't get to find out.
But on a job, they would. Okay. But it's just so important. What we do is what I'm saying. It will change your life.
You have to know what's important to you, like for her to get out of her job and make it happen.
Yeah.
You did those 2 hours.
I don't like working 18 hours a day. It sucked. I didn't like not being able to spend time with my kids. I took my son to work with me. But, you know, it's just, and in fact, I took him on appointments with me for a long time. Till I felt he was responsible enough to stay by himself, but you know, I was wrong at that point too, but at 16, you know, what do you do? So anyways, whole life gives you protection to age 100. It has a growing cash value. It has level premium, so the premium stays the same. It matures or endows at age 100. You guys know many 100-year-old people? Not so much, right? But if you live to be 100, they give you the face amount of your policy. That means it endows, right? And that's what that word means. So if you had 100,000 face amount, when you're 100 years old, you get your 100,000 bucks. Happy, right? But the policy will then end and the cash value equals the face amount and it's paid to the policy owner. So that means you paid that much into it. Whoa, because they only pay you like 3% interest on it. That's not anything. If the insured dies before age 100, only the death benefit is paid, not the cash value. So let's say you've been paying for your policy since you're 25 and you live to be 85. You've been paying for it for forever. Shouldn't your family get your savings and the face amount? That's what I like. That's what we do, right? If you buy term and invest the difference, the family gets it all. But in whole life, you get one. So if you cash the policy out, just take the cash, your insurance is all gone. If you live to age 100 and you get the face amount or you die and your family gets the face amount, they don't get the savings. They'll just take the savings and add the little bit to it and say, here you go. That sucks to me. So ordinary straight life, that's same as regular whole life, right? That's the least expensive form of whole life insurance is ordinary straight life, right? It has your guaranteed cash value as you're paying into it, you know, from age 25 to age 100, and the protection. So your face amount. So this person bought 50,000 and they're going to be paying their premium into it every year for 75 years. Holy cow. It's a long time to pay for insurance, right? It's the most basic form of whole life. The insured pays premiums to age 100. The premiums remain level or fixed the entire 100 years. The face amount or death benefit remains level. It doesn't change. The cash value will equal the face amount at age 100. So pay for it for 75 years. You're going to have $50,000. Whoopee. So if you had 50,000 of coverage, that's not even enough. I mean, at the cemetery where my funeral will be, I paid for mine like 22 years ago when I lost my husband. I paid for my funeral at the same time. So I don't want my kids ever to have to go through that. But I am remarried. My current husband's just going to be cremated, so he doesn't care. But anyways, I called up because my brother lives with me, and I was going to see to have him buried there with us. $30,000 for just the dirt. That's in Hayward. That's insane. You used to pay $30,000 for a house. $30,000 for just the dirt, not even the casket, the vault, all the headstone, all the stuff that goes with it, right? That's another 10 at least. But it's insane. I'm like, oh no, that's nuts. So single premium, the entire premium is paid with a single lump sum payment. The cash value grows the fastest with this type of policy because, you know, you put all your money in at once. And this type of whole life also remains in force till age 100, as long as you don't take all your cash out, right? You got to keep some cash in there. Otherwise, your policy goes away. So single premium grows the cash the fastest. Limited pay has the shorter premium payment period, but is paid to the end of the period, and coverage continues to age 100. That's what I was telling you earlier, right? The 20 pay life policy and a paid up at 65 are two examples of limited pay. The premium payments are higher than a straight life policy, but the policy is paid up faster and the cash value grows faster because you're putting more in all at once. So 20 pay is going to pay it's good to age 100, but if you die before that, it'll still pay the full face amount, right? So you pay the premiums for 20 years or death, whichever comes sooner. And life paid up at 65, your payments are done when you're age 65, but the coverage continues till you're 100 years old. Here's the ugly ones: universal life, variable whole life, variable universal life, interest sensitive whole life, and indexed whole life. The easiest way to get these on the tests: universal, look for flexible. They go together. Variable whole life is going to have level premium. Variable universal, again, look for flexible. Anytime you see universal, look for flexible, right? Interest sensitive, look for current assumption. Interest sensitive, current assumption, they go together. And index goes with index. Keeps it easy, right? So universal life is another type of whole life policy with coverage to age 100. The insurance part of the policy is annual renewable term. Remember what we learned about annual renewable term? It goes up every year, right? The price gets higher. Do you think people understand that when they buy this stuff? They have so many lawsuits about it, I can't even tell you, right? Because people don't understand it. And they start, instead of telling them their premium is going higher, they start taking it out of their cash value until the cash value is all gone. 30 days before it's ready to be gone, they send them a letter saying, you owe us this much money or you have no more insurance. They're like, what? They don't understand it. Nobody explains it. I love, I mean, it's like a love-hate relationship, but I love when I get people early on and show them how it works. If they're older, like older than 50, it breaks my heart because then they have nothing and they can't afford it, right? So premium payments are flexible, minimum or target. Minimum means it's going to cover the cost of insurance only. Target means it's going to cover the cost of insurance plus their savings. So they want to encourage people to pay the target amount, but how many people are going to stay with their target amount if they have a rough month, right? So that can be really hard for people. But premium payments are flexible and may even be skipped, but as long as there's enough cash value to cover the cost of insurance. So they're going to take a loan out of their savings automatically. And this is how they sell it. They say, this is a great product because, you know, some months you might be busy or you might be on vacation or something. You just forget to pay your premium. We're just going to check this little box here so that if you forget to pay your premium, we'll just take it right out of your savings. You don't have to think about it, okay? You're going to say, sure, right? It sounds great, doesn't it? But it's a loan. Loans accrue interest every month, right? If you don't pay that loan back, it's taking more and more of your cash every month. Is that a good thing? Not so much, huh? So there are two death benefit options. There's option A, which is level, and option B, which is increasing. Option A, often in the test, you'll see the word corridor. Corridor goes with option A. Option B is an increasing death benefit. So as the cash value increases, your death benefit can increase. They kind of like to tell you that you're going to get both your cash value and your face amount. I'm going to leave that for the test, and you guys will learn about it as you go. Trust me, it's not a good thing. So option A is quarter, option B, increasing death benefit. Partial withdrawals can be made from the cash value and do not have to be paid back. So if you want some of your cash value out, you can say, okay, I got 100,000, I need 30,000 in cash. You can take that out, but then your face amount is going to drop to 70,000. You don't have to pay it back though, right? It's a better deal, I think. Maybe not for your survivors, right? Okay, you can think of universal life like this. I love this illustration. So when you are buying universal life, you're going to say, we're going to be putting all your money in a bucket for your savings, right? So you're putting in your premiums and gaining interest, and you're hoping your bucket's going to fill up, right? What they don't tell you is your bucket has a hole in it. It's got to pay fees, loads, mortality costs, administrative expenses, and your insurance. So what happens at the end of the policy, you know, at the end of your life, how much is going to be in your bucket compared to how much is in the company's bucket, right? Whose bucket looks bigger now? Yeah. I just don't understand how they're able to sell this. I really don't. I mean, I'm not supposed to be voicing my opinion, but since I'm not really a coach by contract right now, so I'm a consultant, I can say what I want. But to me, it just blows my mind. I don't get it. But 98% of the insurance out there is this stuff, right? Most of what you're going to run into, it's either this or the indexed universal. And that's even worse, right? It blows me away. So the 10 triggers for universal life are flexible premiums, monthly deductions, the cost of insurance plus expenses, the minimum premium versus the target premium, the contract interest rate, the current interest rate, the annual renewable term. Option A, which is the level death benefit option, might have a corridor, right? And option B is the increasing death benefit option. The corridor gap between the cash value and the death benefit is for option A, and partial surrenders or withdrawals, depending how you want to take it, right? Variable life characteristics. Here's your summary of all this stuff. So whole life, the cash values are not guaranteed and will increase. Oh, that's in the investment part. They'll increase or decrease based on the investment results. I'm just going to go down the insurance. Whole life insurance, fixed premiums, face amount increases or decreases, and guaranteed minimum death benefits. In the investment part, the cash values are not guaranteed and will increase or decrease based on the investment results. The policy owner bears the risk of the investment in variable life, right? Cash value is invested in a separate account. Variable and separate go together, right? The policy owner bears that investment risk because they get to choose where their money's invested. Stocks, bonds, and other securities-based investments. So not safe things, right? It's designed to make the person some money. If you see whichever is greater in any of the answers when you're reading your answers, not your questions, right? Whichever greater is the answer. You don't got to read the question, right? So many of you don't even need to read the question at all. You don't even need to look at it. So I would love it if I could just go and sit with you guys and just take it for you. To me, it's so much fun because I know it inside out. Yeah, I wish I could. To sell variable products, you need 2 licenses. You have to have your life license and your securities license. And you know, your securities license nowadays is 3 licenses, right? So you got to have your SIE and your 6 and 63. No, to sell variable insurance, you do. We don't sell variable insurance. We only sell term. So, okay, you'll be fine. But you do want to get your securities license. I mean, if you want to do the whole job, our whole crusade is buy term, invest the difference. 100% of my clients invest with me, 100%. I do not write insurance if I can't write the investment. I've never had a chargeback. Imagine it. because you do the whole job. And my clients have loved where I've put them. I've never had a client complaint in 36 years. So do the job right the first time, you got clients, right? Build those relationships. So you do have to have life and securities license to sell a variable product. So know that. So variable universal life is a blending of universal life and variable life. Oh, yay. It has the coverage of whole life, so to age 100, right? The premium flexibility of universal life. So you can pay different amounts each month, and that's going to determine what your investments are going to be, right? It could also determine your face amount. So you have to be careful. These policies can be a little complicated to read. So you always want to look for the guaranteed amounts when you're looking at a person's policy, right? And that's in the table of contents. It'll say guaranteed cash values, guaranteed premiums, and you can just go to those pages and find it. And I love, rather than point it out to the client, you know, when they have a really crap policy, I just find the parts that they should know and have them read it to me. So could you please read this and tell me how you best understand it? And once they read it and understand it, they're like, holy crap, they didn't tell me that. Guess what? If they didn't tell them that, they can go to court and get all their money back. I've been to court with a ton of clients, tons of them. I spent a lot of time doing that. It only takes like an hour or two, but guess what? You win a case for them because you're the expert witness because you're an agent, right? So you can tell them, you know, this is what the law says. They have to explain these things. As soon as you say that, oh, and they didn't, okay, you win. You get all your money. They go tell all their friends. You got a whole bunch of new clients, right? So it makes a world of difference. I had a client once, I went to her house and she had a policy that was supposed to be an investment for her daughter's college. Her daughter was 17 when I met her. And this blue policy that she had a whole cash value that she'd been paying for 16 years, 87 bucks. Yeah, that's what she was in tears. I mean, she just didn't know what she was going to do. I had to calm her down. I said, it's okay. We're going to fix it. And she's like, wow. I said, can you just write down for me everything you recall your agent telling you? And they did sell it to her as an investment, and it wasn't. It was just a straight life policy. And so I took that and I made a copy of her policy and I sent it up to the insurance commissioner. And they shut that big rock company down. For 2 years, they were out of business. Yeah.
That's what they mean by fraud.
Yes. That's what they're doing. Yeah.
That's why, you know, people, you know, don't try to get it. Feel like
yeah, they're going to be ripped off. So that's why we have to do our job, right? Really explain it to them, help them to understand the difference between term and whole life. Because whole life will rip you off every time. It does. It's not a good investment.
Well, what's the best investment?
I can't talk about investments right here, but when we're done, I'll help you with that. Okay. So anyway, it has the coverage of whole life, premium flexibility of universal life, the investment component of variable life. You must have both licenses, the life and securities license to sell this stuff. And you need to remember that variable and separate go together, right? The insurer must have one or more separate accounts to do variable insurance. So interest sensitive whole life, remember current assumption and interest sensitive go together. You don't have to know what it means. You just need to know they go together, right? You're going to learn all this nonsense when you're out in the field, I promise you, right? If you ever run across one of these, I've run across one in 36 years of this type. So not something you're going to use every day, right? But once you get it and you go to the guaranteed values, you'll know it's easy. So anytime you guys ever in the field and you have a question, always call your upline, right? You can get answers that way really easy. So it's also referred to as current assumption life. The initial premium is based on the current assumptions about risk, interest, and expense. Premiums may increase or decrease at designated intervals based on the insurer's actual experience with investment and death benefits. The cash value interest rates may also vary since they're based on money market rates. It has a minimum guaranteed interest rate, but can earn higher. That's one of the other answers, can earn higher. So if you see that, choose it, right? Can earn higher. Indexed life is also referred to as indexed whole life or equity index whole life. Cash value is based on the performance of an equity index, such as the S&P 500, with a guaranteed minimum interest rate and fixed premiums, but it's going to pay whichever is higher or whichever is greater. So anytime you see higher or greater, you know it's going to be your answer. Don't even worry about the rest of it, right? The face amount will increase annually to keep pace with inflation without requiring evidence of insurability. So your face amount is going to increase. That could be another answer for that. So that's the only three for current assumption or interest sensitive will be current assumption and excuse me, the equity index and the face amount increases. And without requiring evidence of insurability means no new medical, right? Combination plans. So insures more than one life. Joint life pays on the first death. The premium is based on a joint average age of the insured. So the premium is going to be lower than two separate policies, right? The death benefit is paid upon the first death and then it's over. In survivorship, which is second to die, the premium is based on the joint age of the insureds also. It's going to cost less than joint life because they're going to be paying for it longer. So the premium is less for joint and survivor than it is for joint. Make sense? The death benefit is paid on the last death, and then it's gone. It's used to offset liability of estate tax upon the death of the last insured. I've only written 2 policies like that to cover estate taxes because the clients had like gazillions of dollars, right? So we didn't want their family to have to pay estate taxes. So they got an extra insurance policy just to pay for that. No, 3 of them, 3. So annuities, y'all get confused on annuities. In California, we usually only have like 8 annuity questions. If you missed them all, it wouldn't matter if you got a lot of the rest of them right. But annuities, here's what you need to know. It's a contract established to systematically liquidate a sum of money, right? Life insurance creates an estate. An annuity liquidates an estate. It's often used for retirement. So what's an annuity used for? Retirement. They suck, though. I have to tell you that. I mean, as a school teacher, had an annuity, right? And it was a new plan. I was like the 13th employee at the school I worked at, right? So before I started Primerica, we had just barely started it, and I had a whole $250 in my account, right? And so I figured, well, what the heck, I'll just leave it there. Because when I started Primerica and I showed my principal what we do, she let me write it for the whole school. So now it's a whole district. It was only 1 school when I started. Now it's like 3 schools and I write them all. But I decided just leave the annuity, see what happens. It matured when I was 65. Guess how much money I had at age 65 on my $250? $500. It doubled only 1 time in 35 years or 30 years. That's insane, right? So I can show that to people. This was my annuity. Is that something you want to invest in? Help yourself. You know, there's some decent ones out there that'll pay you like 7%, but 7% after what? There's so many expenses in there that you have to be like an actuary to be able to figure out. So I just don't like to write them. I only write them, like I said, my extremely wealthy clients that we've, you know, invested money everywhere else we possibly could, maxed out, then write them. Or if you have somebody that absolutely has to have a guaranteed return, they're really afraid of the market, then you can write it, right? That's just my opinion. So an annuity is a contract established to systematically liquidate the money, right, for retirement or specific needs. Annuitant is the person on whose life the contract is written and who is the recipient of the payments. So you can write an annuity for anybody. right? You say, I want to have money for my kid. They're not responsible or whatever. If I want to take care of my brother, I could have an annuity for them where they'd get regular monthly payments for forever, their whole life, right? Only thing is you just don't know what amount it's going to be because of the expenses in there. I've had clients that had annuities that were paying $3, $7, you know, cost them more than that to write the darn check, right? So, but the annuitant doesn't have to be the person paying for it. You can buy one for anybody you choose. Doesn't even have to have insurable interest at all. It can be anybody you want, right? So the owner is the person paying for it, right? And the owner has what? All the rights, right? Y'all falling asleep on me? The beneficiary is the person who receives the benefits should the annuitant die. So if you didn't buy a straight life or ordinary life annuity, then you have a beneficiary. 98% of all annuitants are written as straight life. They have no beneficiary. So if the annuitant dies 3 weeks after they started taking their payments, guess what? The company keeps all the money. Sound like a good deal? Always make sure if you write one, you might make sure they have a beneficiary, right? It's not going to be that much difference in payments. So the characteristics still, accumulation period, that's the pay in period. When you're accumulating money, right? The owner can make changes during this time. You can pay in whatever you choose. It's your savings, right? So you can pay 75 this month and 500 the next month and 30 the next month. Who cares? It's your savings. That's flexible. The annuity period, however, is the payout or the liquidation or converting it to a stream of income. All those mean the same thing. You're taking your money out, right? So the payout period of the annuity is the time during which the principal and the interest are used to make payments to the annuitant. The company controls the annuity during this time. So you're putting your money in. I'll show you an illustration in a minute. The immediate annuity benefits payment, if they begin within 12 months, it's immediate. So if you start getting them in 10 months, it's immediate. 5 months, it's immediate. 11 months, it's immediate, right? Anything before 12 is immediate. After 12 is deferred. An immediate annuity can only be paid for with the single premium because you're going to have immediate access to your cash, right? So say you win the lottery. If you win the lottery, they're going to put it in an immediate annuity so you can start getting monthly payments right away, right? They don't give you a whole lump sum. That's nonsense too. So that's an immediate annuity. But a deferred annuity, the payments begin more than 12 months. So after the first year, you start taking your payments. Usually deferred annuities have a set period of when you can start taking your payments. They're like 5, 10, 20, 50, whatever you choose to buy, right? And then you start taking your payments. That's deferred. Your earnings will grow tax deferred. So you don't pay taxes on it until you take the money out, right? Something about taxes. If you get that god-awful test that we have that has all those tax questions on it, you need to know interest is always taxable. What is interest? More than what you paid in, right? So if you paid $70,000 into an annuity, but you have $100,000 in there, how much of that was interest? $30,000, right? So that's going to be your taxable part. That's your exclusion ratio, they like to call it in the test. So exclusion ratio has to do with how much is going to be paid in taxes. So here's how they work, right? You're a skier and you're just trudging up that hill, putting your money in a little, and it's accumulating. And all of a sudden you're ready to retire. It might be when you're 40 years old. It's up to you, right? You might be buying an annuity to give you cash until you're 60. So you want money to save for 20 years you have there that'll last you until you can collect your retirement? Annuity might be good for you. I don't know. But when you decide to annuitize or take your money out, you're deciding how you're going to take it. Do I want monthly payments for life? Do I want monthly payments for 20 years or 10 years? Do I want all my money right now? Whatever you decide at this point, you can't change your mind. You're in a legal contract, right? So if you decide you want money for life and 10 years down the road, you decide how you really need your money out, you're out of luck, right? So They are very legally binding. So be careful what you put people in. Make sure it's suitable for them. Make sure they understand how it works, right? If you don't understand it yourself, guess what? Our people from the annuity places, like, Marlon Ignacio with AIG, he comes to my house. He'll go on any appointment I ask him to come on and explain it. I don't even have to. I still get paid for it, right? So we have tons of support to help us. Never say something that you're not sure of, because you will not only be held liable, but the company will as well, right? So make sure you know what you're talking about. If you don't say, I'm not sure, let me get that answer for you. I'll find out and I'll get right back to you. You call your upline right now. If your upline can't help you, then you say, I'll get back to you within 24 hours. You call the home office. They will get help for you. Even if they need to get on a conference call with you, they're awesome at doing that, right? So accumulation is pay in, annuitization, pay out, converting it to a stream of income, right? That's annuitization. So this thing, let me go all the way up to the end of them, because I think there's one more. Let's see. Nope, I always go one too far. Let me see. Okay, this one you can take a picture of. Get this out of the way so you can see the top of it too. Technology just always in the way, right? So that basically tells you the cycle of an annuity, right? It confuses me. I'm not good with graphs. I like it just written in a list. So that's our next one. Ready for your little quiz. Okay, which of the following is not a characteristic of term? Not a characteristic of term. Correct. It doesn't build cash value, right? It's just pure life protection. Which policy would be the most appropriate for protecting a loan or a mortgage? Decreasing term. Definitely. Good job. How long does coverage continue for a limited pay whole life policy? Yes, death rate 100. Good job. And insured has purchased a 100,000 whole life policy. After a period of years, the cash value of the policy has grown to $42,000. If the insured dies at this time, how much would the beneficiary receive? A, it's a 100,000 policy. They get 100,000, right? They don't get the savings. Doesn't that suck? Okay. Which of the following is not correct about universal life? Why is that up there? That's what I thought, but that's not. There it goes. Okay. Which of the following is not correct about universal life? Yeah, because it's annual renewable term, right? Job. And a policy that insures 2 or more lives and pays on the death of the last is what? Good job. You're all going to get that one. Which type of policy builds cash value that is placed in a separate account where it's invested in stocks, bonds, and other securities? What goes with separate? Variable. Yes. Variable. All the following are true about fixed annuity except hello? Anybody? D, the owner assumes the investment risk. That's in variable, right? Not fixed. An immediate annuity has no accumulation period, which means it can only be purchased with a what? Single premium, yes. Good job. Which of the following is not true about variable annuities? Hello, anybody? C, correct answer. Premiums are invested in conservative investments such as real estate and mortgages. No, the idea of variable is to make money, right? Well, there you go. And if the annuitant should die during the accumulation phase, what will the beneficiary receive? See if anybody remembers. Yes, whichever is greater. When you see that, it's your answer. You don't even got to read the question, right? Whichever is greater is the answer. That's another 2-hour one. Rights and obligations of the policy owner. Insurance company protects the policy owner, and also known as clauses, the policy provisions. Riders are supplemental additions or extras that you attach to your policy for additional premium. They're not free, right? So most common is your spouse, right? Waiver of premium, child riders, those are added to your policy for an extra cost, right? The entire contract is the policy, the application, and any riders. That's the entire contract. That's a test answer. The insuring clause is the insurer's promise to pay the benefits. The free look provision, the owner will receive a refund if dissatisfied for any reason in the first 10 days. It begins when the owner receives the policy, right? So don't sit on those policies. The consideration clause is the exchange of something of value, premium for a promise, right? The owner's rights, all rights to the policy belong to the owner because they pay for it. Beneficiaries can be anybody or anything, really. Individuals, trusts, estates, charities, minors, or classes. But a minor, you must have a trust, right? Or trustee, because minors can't accept cash. It's not allowed. So the designations, the primary is the first in line to receive the proceeds. The contingent is the secondary. They receive the death benefit if the primary dies before the insured, and tertiary would be third. Okay. So if, say I still have life insurance or I'm my husband's beneficiary and I died before him, then the kids would be the contingent. So they would get the death benefit, right? So the only way they can do that is if they're listed on the policy as a contingent. If there's no contingent, the money's going to go to the insured's estate, and the state's going to take like 65% of it. So don't let that happen. Make sure everybody has a beneficiary and a contingent beneficiary, right? Even if the contingent is a charity, you can do that, right? A revocable beneficiary may be changed by the policy owner. An irrevocable cannot be changed without the signature of the beneficiary. Remember, I was telling you about insurable interest early on, where my husband and I had a policy together, right? When we divorced, the court named me as an irrevocable beneficiary. He was not allowed to make a single change to that policy, not stop paying it. He had to keep paying it no matter what until our kids became adults. That's irrevocable. He could change it if I would have written a letter and said it's okay, but I wasn't about to do that, right? So, yeah. So common disaster clause means the insured and the beneficiary are in a common accident and die at the same time. This determines who died first. If they die within 90 days of one another, they're going to say that the beneficiary died first, the primary, right? So that the money would then go to the insured's beneficiary or estate. That makes sense? If no beneficiary is named or alive, where does the money go? To their estate or to the state. This is pretty much what happens. It's ridiculous. Premium payment provision, it's paid in advance to the producer or the home office of the insurance company, and usually at 12, 6, 3, or 1 month intervals called modes. If you see mode or modal premium, if you see the word frequency, those two go together. How often do they pay? Every month, every 3 months, 6 months, 9 months, every year? How often do they pay? right? So that's what you want to do. If you're able, when you're out in the field, try not to take quarterly payments. Those we call lapsomatics. Because people, the only client I have, period, that would do a quarterly is my daughter, because she knows if she didn't pay her premium, I want to kick her butt, right? So, but other than that, people, if something comes up in 3 months, they're not going to pay it. It's just going to be done, over with, right? And you'll have a lapse and you'll get a charge back. You don't want to do that. So I just tell people, rather than, something come up, I mean, you're writing this to protect your family, right? Say in 3 months, something happened and you didn't have the money to pay the whole 3 months. What will happen? It's just easier just to do it every month, right? So that's the easiest way to put that. So annual premiums are the least expensive. It might seem like the most because you're paying out a chunk at one time, right? But you're not paying any finance charges on it. So you're really paying the least. My first year in business, I didn't write a single monthly PAC. Every single one of them paid annually because our premiums were so cheap compared to what they were paying on our whole life. Yeah, they call me the annual queen. So, yep. So grace period is how long? 31 days. The period of time, usually 31 days after the premium is due, that the policy owner has to pay the premium before the policy lapses. So if you're due on the 1st and you forget to pay it, and on the 12th you die, what's going to happen? They're going to cover it, but they're going to take out the premium that was due, the 12 days worth, right? So minus any premium due. If you see minus any premium due, it's your answer. Simple, right? It protects the insured against an unintentional lapse of the policy, yes. And the death benefit will still be paid if the insured dies during the grace period, minus the premium due. So you see, minus the premium due, just know it's the answer. Don't even read the question. Doesn't matter. Questions are designed to confuse you. It makes money for the test provider, right? So if you know all the answers, just mark the answer and go on. Don't be marking them for saving for later. Just do it and go, right? Automatic premium loan only applies to cash value policies, not term, because there's no cash to borrow from, right? Automatic premium loan, or the APL, is a loan in the amount of premium due is withdrawn from the cash value to pay the premium to prevent an unintentional policy lapse. So they're going to automatically take it out of your cash value to pay your premium. They would have to do that immediately after the grace period, right? And then it's a loan. You got to pay it back with interest. The policy owner may borrow up to the cash value, not the face amount, the cash value. Can't borrow more than what you have. Outstanding loan amounts will be deducted from the death benefit. So if you die and you haven't paid back the loan, they'll take it off of your face amount. Okay. If a life insurance policy lapses, it may be reinstated if certain conditions are met. It has to be within 3 years of lapsing. So this is the one you have to know. It's 3 years. Reinstatement and 3 go together. Otherwise, most of your years questions are going to be 2 or 5, right? This is the only one that has 3, is reinstatement. You must have a new medical, prove insurability. You must pay any overdue premiums plus interest on those. And you must repay any outstanding loans with interest. You do not have to pay next year's premium up front. They say you have to do all the following, except that's the one you don't have to do. You don't pay next year's premiums up front. Incontestability. It prevents the insurer from denying a claim because of statements made on the application after a policy has been in force for 2 years. During the first 2 years of the policy, the insurer can contest a claim if the insurer feels that misleading or inaccurate information was provided on the application. Likewise, the insured, if they weren't explain the policy properly, if I could talk, would be good. But if it wasn't explained to them where they understood it, they can still go and get their money back as well in that 2 years. If it's a material misstatement, materiality is very important. Anytime you see material in the answer, it's probably going to be your answer, right? It does not apply to non-payment of premiums, and it does not usually apply to statements relating to age or identity. If you misstated your age or your gender, they're just going to pay what it would have paid with the premiums you paid in, right? It's like my mom, I never knew her true age until she was like in her 90s. You know, she had 3 different birth certificates. You know, she was born in 1927. Back then, it wasn't such a rare thing for people to lie on their birth certificate so they could get a driver's license. She got her license when she was 14. She was not 60, right? But you do what you got to do in life to survive. She was having babies at 15. So, you know, that was common back then. It is not so much anymore, thank God, right? So, assignment is to transfer all or part of your policy ownership to another person without consent of the insurer. You must advise the insurer in writing that it's going to be assigned. An absolute assignment means you're going to sign away all your rights, transfer all the rights of the policy to somebody else. That was really common when AIDS was prevalent. People would sign away their life insurance to a settlement company to get some cash, right? A collateral assignment is only a temporary assignment. I've only written one of these. It was for my dentist. He needed $1 million collateral assignment while he was building his house. He had a $2 million policy. So we just took $1 million and said, well, if anything happens during this time, your kids will get half in each, right? But as soon as he paid off that loan, we took the collateral assignment off. So, but it's temporary. Collateral is temporary. But generally, if you see collateral in the answer, it's the answer, right? Misstatement of age or gender. This provision allows the insurer to adjust the death benefit amount if a misstatement of age or gender is discovered once a death claim has been submitted. If the insured's age or gender is misstated on the application, the insurance company will adjust the benefits to the correct face amount the premiums paid would have purchased. The insurer would then adjust the age and use the correct rate from the date the policy was issued. So they're gonna pay what it would have paid if they had told the truth, right? It is not our job to go and ask somebody if they're lying about anything, right? Generally, I mean, we're living in an age of a lot of trans people. Usually they're pretty proud of it. If they tell you, then you can just say, great, did you have it changed on your birth certificate, right? If they did not, you have to tell them for legal reasons, you have to be the same at birth as you were at death. So we'll have to write you here as whatever they were at birth, right? And if you go to court and have it changed, let us know and we will change it. Just show us your new birth certificate. Because a lot of them don't even realize. No, it has to be on their birth certificate. Yeah. So only if they tell you,
Okay.
you can't ask them.
Right.
Even if you know, you can't, you know.
Yeah.
So that's illegal. We can't discriminate.
Okay.
So, but it is so important that they understand that, right? Especially if they're paying different rates for male and female.
Right.
So, yeah. But if they get their birth certificate changed, we have to do what it says on their birth certificate. Riders. Riders are additions to the policy for additional premium, right? There's a waiver of premium. There's a waiver of monthly deduction, guaranteed insurability, pay or benefit, accidental death and dismemberment, term riders, other insurance, long-term care, and return of premium. Those are all riders. You can add them to your policy for additional premium, not free. A lot of them will say without. So you got to look at the words in those answers, right? If it says with no additional premium, you know that's wrong. It doesn't belong there, right? Waiver of premium waives the premium if the insured becomes totally disabled. There's a 6-month waiting period before the first premium is paid. Premiums are refunded from the start of the disability after 6 months. So they'll get that 6 months back. So you want to make sure they're investing their money and have an emergency fund, right? Because the first thing they're going to cancel if they become disabled is their life insurance, right? And that's when they need it the most. And I always tell them that when I'm writing, right? I always, anybody over 55, I write a waiver premium on. I never even ask them about that. I write it and say, I added an additional waiver premium on here for you. It's costing you $1 more a month, whatever. It's $1.50 maybe. It's not a lot ever. So And they say, what's that? And I said, well, if you should become disabled, you can still pay your premiums for 6 months, but then the company will refund that money after 6 months and continue to pay your premiums until you're able to go back to work or reach retirement age, whichever comes first. And they're like, great, thank you so much, right? Because they didn't know about those. Nobody told them, right? So I always add those on. And so you want to make sure you're writing your investments so they have money to pay for those 6 months that they're not working. So they can afford it. Future premiums are then waived after 6 months and they expire at age 65 when you're eligible for Social Security. The deduction is found on universal life and variable universal life policies because the deductions, while the insured is disabled following a 6-month waiting period, just like the other one, but that includes the cost of the insurance charges, expense charges, and cost of any benefits added to the policy, not the cash value, right? So waiver of monthly deduction is found in universal and it covers the cost of insuring them, but not the cash. Oh, what happened? Fudgioli. Where were we at? 81? Thank you. Now, if I could see, it'd be great. There we are. Okay, dividends and dividend options. It is 87. That's not what I wanted. Oh, thank you. Go back. There, we were here. Yeah. Thank you. Guaranteed insurability we needed, right? Payer benefit is usually attached to life insurance written on the lives of children. So a parent buys a policy for their child and they want to make sure that those premiums get paid. If anything happens to them, right? They would buy a payer benefit rider. So it's same as the waiver premium, but it pays the child's insurance premiums. So, the premiums would remain waived until the child reaches their limiting age, which is 21, right? And then they have to buy their own policy. Guaranteed insurability allows the policy owner the right to purchase specified amounts of additional insurance at future dates, ages, or events at an additional charge with no insurability, no proof of insurability. So, excuse me, specified amounts at specified dates or times, right? Oops, wrong way. Accidental death pays a multiple of the face amount if the death occurs as a result of an accident, not due to sickness. So which of the following might pay a double or triple benefit? It would be an automobile accident, right? It would pay, let's say Sarah has 100,000 policy and she died as the result of an accident. She had a double face amount. How much would her beneficiary be paid if she were killed in an accident? 200, right? But let's say Frank, he has a triple indemnity rider. It's 100,000 face amount. He dies as a result of a head-on collision, but it was his fault. How much would the beneficiary get? The 100,000. It wouldn't triple if it's his fault, right? So death must occur within a specified period of time, usually 90 days. The accidental death and dismemberment, AD&D, would pay a percentage of the face amount due to an injury. So a capital sum, a percentage of the face amount is paid for the loss of one hand, arm, leg, or eye, or the full face amount if you lost both hands, both eyes, right? Both legs. Term riders are used to add additional temporary insurance on the insured without having to take out an additional policy. So they just add it to it for a little extra money. Other insureds are attached to base policies to add term coverage for your spouse, children, or even non-family members, such as in a business policy. So partners can do that, right? I can have my brother, he's my dependent. He could be on my policy if I still have a policy. Return of premium, increasing term added to a whole life policy that provides if death occurs prior to a given age or time, not only is the death benefit payable to the beneficiary, but all the premiums paid in would also be refunded. Remember, increasing term goes with return of premium, always, right? Increasing term and return of premium go together. Long-term care provides payment of a portion of the death benefit to assist with healthcare expenses incurring in a nursing or convalescent home. Anytime you see nursing or convalescent, you know they're looking for long-term care, LTC, right? They go together. It reduces the death benefit. That's the other LTC question. It'll reduce the death benefit to this beneficiary by the amount that they used while they were still alive, right? That's why you want to make sure people have plenty of insurance, right? Not just a bare bones if they can possibly afford it. Policy options. Options are choices or decisions made by the policy owner. There's 3 types of policy options. I like to call them a rec. They like to call it a little differently. So non-forfeiture options are 3 of them. There's dividend options, 5 of them, and settlement options are 5. So the non-forfeiture options is the 3. That's the REC. So they are the cash value accumulated by a whole life policy always belongs to the policy owner. By law, it cannot be forfeited. That's cash. I would like it to say reduced paid up first. That's the R. And the E would be extended term. And then the cash is the C. So it's kind of mixed up, right? So that's what I need to fix the slides, and I just honestly haven't had time. So non-forfeiture is the cash always. Once you take the cash, your policy is done. You cannot renew it, extend it, do anything. It's not good for 30 more days. No, it's over with as soon as you take your cash, right? Reduced paid up means you're going to take the cash amount that you have and buy a reduced paid up policy. So instead of 100,000, you might have 15,000, but it's paid up until your age 100. You don't have to pay any more to it, but the cash value in it will continue to grow. Okay. Extended term is the automatic non-forfeiture option. If you didn't choose any, then they will make it extended term. Extended term will be the same face amount. So it's the highest face value, right? Because it stays the same as what you have, but it's only for a period of time. It might be for 1 month. It might be for 5 years. It depends how much cash you had in there, but it will be the same face amount. So extended term is the automatic and it has the highest face amount, right? Reduced paid up lasts the longest because it goes to age 100. And the cash, everything's done as soon as you take your cash, right? So there's your cash surrender. The insurer sends a check minus any applicable surrender charges to the policy owner with the cash option. The original policy cannot be reinstated. It's over. Dividends and dividend options. Dividends are a return of unearned premium. They are not guaranteed and they are not taxable because it's a return of excess premium, a refund, right? That's a dividend. Never guaranteed, never. So remember that. They like to ask 2 or 3 questions about that in the test. Not guaranteed and not taxable. Cash, the insured sends the policy owner check in the amount of the dividend. You have a reduction of premium. It's used to reduce the next premium payment by the amount of the dividend. So usually it's next year's premium, right? Accumulate at interest. The insurer keeps the dividend and pays interest on the account. Dividends are not taxable, but the interest earned is taxable. So they're going to be paying taxes on that right away. Interest is always taxable. Always remember that, right? Interest is anything more than what you paid in, or the cost basis, they like to call it, or the principal, right? And paid up additions. They're used to purchase a single premium policy at the same type as the original. Each of these small policies will increase the face amount. So what kind increases the face amount? Paid up adds, right? Paid up additions will increase your face amount. And then you have 1 year term. That's used to purchase a single premium. 1 year term is in whatever amount your cash is going to buy, your dividend will pay for, right? That will also increase your face amount, but for 1 year. So if they're looking for 1 year term in your answer, it'll say 1 year in your question. That's the easy way to know that they're looking for the term answer, right? So look at all those together. You got CRAPO, CRAPO. CRAPO is dividend options. Dividend options are CRAPO. Easy way to remember them, right? Cash, reduce the premium, accumulated interest, paid up adds, and 1 year term, CRAPO. And then we have CLIF. CLIF is your settlement options. So you have your cash, your 1 lump sum payment, then everything's gone, right? Life income, you can have an annuity, pays for the life of the beneficiary. Payments stop when the beneficiary dies. Again, we don't know how much that's going to be. It depends how much cash you have. If you didn't have very much cash, you might get one of those checks like my clients had that paid $7 or $3 a month. Yay, right? So interest only. The proceeds are held by the insurer to accumulate interest, and the beneficiary receives interest payments at regular intervals, paying taxes on that interest, right? Fixed period installments. So the proceeds will be paid over a fixed period of time, such as 10 years, 20 years, etc. The dollar amount paid will be determined by the amount of the death benefit and the period of time chosen. So in the test, if they say Sarah is going to be getting her $2,500 a month for 10 years, they're telling you the period, right? So you know it's fixed period. If they say Sarah's going to be getting $2,500 a month, they're telling you the amount. If they don't put the years on it, they're telling you the amount. So it's fixed amount, right? That's how you tell those two apart. They just tell you. If you can figure that out, it's not tough. Don't overthink it, right? So options. Here they are. There's your little graphic. There's your wreck and your crapo and your cliff. Exclusions. Exclusions are things that they will not cover. So remember I told you I had a little girl and the company sent me a check for 10 grand? Well, that's because she didn't die as a direct result of her disease. That was the exclusion they put on it. She had myotonic dystrophy. She was blind and had myotonic muscular dystrophy, right? So if she had died directly as a result of her disease, they wouldn't have paid me. But because her parents starved her to death, they paid. So most common exclusions are a wash. They're war, aviation, suicide, and hazardous occupations or hobbies. So if it doesn't begin with W, A, S, or H, it's probably not an exclusion. Make that simple for you. Exclusions are a wash. Here's your quiz. Which type of assignment would be used for a loan? Remember, temporary is collateral. Yes. If a policy owner returns a policy 7 days after it's delivered, the insurer is going to do what? Yes, refund the full premium paid. If an insured dies during the grace period, the insurer will pay what? Yeah, minus the premium due, right? Which of the following is not a requirement of the reinstatement provision? D. Says at the current attained age. The whole purpose of reinstating is to get it back at the age you were when you purchased it, to keep your premiums low, right? Because like between 27 and 30, premiums change a lot, right? So if they let it lapse when they were 26, they're going to definitely want to reinstate, right? If an insured dies 3 years after the policy was issued and understated his age on the application, what will the insurer do? Yeah, they're going to adjust it. Oh. Anytime they understate their age, they adjust, right? The death benefit, not the premium, the death benefit. What's the name for the first beneficiary listed in a policy? Yes, the primary. Which dividend option would be taxable? Yes, interest. Interest is always taxable, right? And which non-forfeiture option prohibits reinstatement of the policy? Yes, the cash. Once you get your cash, you're done, right? Good job. Which of the following riders functions like a waiver premium rider but is found on juvenile policies? Payer benefit. Good job, you guys learned. How long must a policy owner be disabled to receive benefits from the waiver premium? 6 months, yes. If the insured elects a partial payment from the accelerated benefit, the death benefit of the life policy will C, be reduced by the accelerated payment amount. Which of the following riders allows for increases to the face amount at specified times with no proof of insurability? No proof means guaranteed, right? There you go. All the following riders would increase the death benefit amount except B, waiver premium. Next one's the same. All the following will reduce the death benefit amount except waiver premium, right? Okay, taxes, retirement, and other insurance concepts. Third-party ownership, when someone other than the insured is the owner of the policy, like a parent to a child, right? That's third party. Commonly found with juvenile and business policies. Group life, when it's written for employee-employer groups, no evidence of insurability is required. It's annual renewable term, and the insurers receive a certificate of insurance, and the sponsor receives a master contract. So the employer has the master policy. The employee gets a little card that says, I'm insured. That's your certificate, right? So what do you get if you're the employee? Certificate. And if you're the employer, you get master contract. Good job.
What if you don't get it? Do you know you're insured?
You can't prove you're insured if you don't have it, right?
What if you don't get paid for it?
You-
There's big companies that literally don't give the employees a certificate.
I've never seen that. I've never seen that. I don't know what you do if you go to a doctor or something and you say, hey, you know, like your medical insurance, you do the life insurance. The life insurance is in your contract. You're fine. Yeah, that you'd be covered. As long as your family knows and they have a cop, you know, like one of your pay stubs that shows you're paying it, then they would. We have a certificate for ours. I make my husband buy his work insurance because he's a smoker and it's expensive and I wasn't going to pay for his insurance. I said, no. So you're going to buy it and you're going to work until you die or quit smoking, whichever comes first. So, yeah, I've seen it. Yeah, on life insurance, I've definitely seen it. So like I said, make sure somebody has a copy of your pay stub, somebody you trust, right? Yeah, that would be important. And, you know, make sure you write down how much coverage you're paying for. So. Always, yeah. Yeah. And it's good to make sure that somebody that you trust has a copy of it. Because if you die, it does nobody any good if they don't have a copy of it, right? Like, yeah. Sorry. All of my stuff is in my daughter's freezer. Seriously. Because I've lost a house in a fire and a freezer doesn't burn and people don't usually rob a freezer. So my will and my insurance documents, all of my stuff is in her freezer. Yeah.
That's very smart.
Mm. Yeah. Yeah. They'd never find it in her freezer. They'd have to empty it. But she knows where it is and my son knows where it is. That's all that matters, right? It's in a Ziploc bag and taken care of. It's fine. I check on it every now and then, make sure they didn't mess with it. But yeah. So. Group life, you have a conversion privilege, the right to convert to an individual policy without proving insurability upon leaving the group if you've been with them 5 years, right? New policy can be any form except term, which means it has to be whole life, right? The new face amount must equal the face amount of the group coverage. So whatever you had in the group is what you would have as your own, right? The employee has 31 days to exercise that conversion. So if death occurs during the conversion period, the death benefit would be paid by the group policy. So if you leave your job, you have 31 days to convert. So you're still covered for 31 days. If you've been with the company 5 years, that's the little caveat, right? Contributory versus non-contributory. When the employer pays all the premiums, the plan is non-contributory. You don't pay out of your pocket, right? That means 100% must be included. They must participate. You can't exclude anybody. When the employer and the employees share the premium, the plan is called contributory, and at least 75 must participate. 75% for contributory, 100% non-contributory. Very testable. Selling an existing life policy to a third party for a percentage of the face amount in order to pay expenses incurred due to a life-threatening illness before death is called a viatical settlement. The new owner continues to pay the premiums and they receive the entire death benefit when the insured dies. So the insured is going to get a percentage of the face amount, usually like 15 or 20% is what I've seen. Some of them will pay more now. If you know it's a policy that you don't need and you want to just sell it, they'll give you a little more maybe. But you got to negotiate those things, right? But they're going to sell it for a percentage of the face amount. The viator is the insured on the policy and they stay the insured on the policy. The settlement provider is the person or company who enters into the settlement and buys the policy. The producer represents the provider in the purchase and the broker represents the insured in the sale of the policy. So you're probably going to get at least 2 questions about that. And you're going to need to know who the viator is and who the broker is usually. Sometimes there's one about the provider. Right? So the broker is going to represent who? The insured, right? The viator is the insured and the provider is the company who enters into the settlement. Selling a life policy to a third party for some form of compensation, usually cash, requires an absolute assignment of all policy rights to the new owner. So it's not your policy anymore. You're just the insured, right? Usually done because the insured no longer needs the policy or the cost of the policy has gotten too high. Selling a policy may result in a larger payment amount than surrendering it for its cash value. So if you can negotiate with another company, you don't want to keep it, you don't want to keep paying for it, you can say, hey, look, I have this much cash, so why would I sell it to you, right? So you can negotiate those terms if you wanted to sell it. A lot of companies now are saying they'll even buy a term policy, but usually that's for somebody that's old. They expect them to die soon, right? Otherwise, they're not going to plunk money into it. They would lose their money if they were betting on me. My mom lived to 96. I plan to be 100, you know. Life expectancy is important in life settlement contracts since it is used to estimate the insurer's projected life expectancy due to medical history and mortality rates. So do they expect you to die when you're 85? That's when most women are expected to die. Most men expected to die at 80. That's just the statistics these days, right? Like I said, my mom lived to be 96. The only reason she died is because her hip broke. I don't think my hip's going to break. I'm pretty healthy. And I take better care of myself. So I'll probably live to be 100 at least. So it's how are things in your family, right? And do you take care of yourself? That's important. Qualified retirement plans. To be qualified, a retirement plan must conform to the requirements of the federal tax laws in order to receive favorable tax treatment from the IRS. The employer contributions are tax deductible expenses. So that's a good one, right? Employee contributions are not taxed until they're paid out at retirement. So that's a win-win for both the employer and the employee, right? No taxes until you take the money out. Growth in the account is not taxed till benefits are received. And hopefully, you know, people are in a lower tax bracket. I like to tell people I want to create an estate tax plan for you, right? We want you to have that problem. Isn't it better to have more cash and have to pay taxes than have no cash and still have to pay taxes, right? So make sure you get those investments going. Qualified plans cannot discriminate in coverage. You know, they can't say they're only for our key employees, right? They have to be for everybody, all the employees. So no discrimination in favor of their highly compensated employees, shareholders, or the company officers. The contributions to a non-qualified plan are not exempt from taxation, and they can discriminate. So if it's like a deferred compensation plan, we're going to put this much money away for you for a retirement, and you'll just have it then when you're in a lower tax bracket because you're older, right? Those they can discriminate and pay it to whoever they choose or not choose, right? But qualified plans have to be for the employees. So here's your little graphic. So traditional IRAs contribute 100% of earned income up to certain limits, and you know, that's usually like 6,000 a year. You pay a 6% excess contribution penalty. So if you put in more than you're allowed each year, they're going to penalize you 6% until you take it out. It does grow tax deferred until retirement. The contributions are made with pre-tax dollars, so they're coming out, you know, before you get paid. 10% penalty for early distribution. So before age 59 and a half, unless you have like a life-threatening illness, usually is when they'll let you take it without a penalty. And payments must begin by age 72. And if you don't start taking it out by the time you're 72, you pay 50% penalty. That's huge.
And that would be considered like a 401k?
Yeah. Or an IRA. Yep. If you don't start taking it out by 72, you're screwed.
And if you take it before it, they'll
You can start taking it out as soon as age 59 and a half. That's if you take it out before 59 and a half, it's a 10% penalty. Right?
You can ask for loans and stuff on the phone. Well, right?
Yes.
But then you have to repay it back.
Yes, you do. Otherwise, you're paying taxes on everything that you haven't paid back. Right? But in a Roth IRA, that's the one gift they've ever given us from the government. In a Roth IRA, you never pay taxes again. As long as you keep it at least 5 years or till age 59 and a half, whichever comes
So
soon.
you convert your 401k to a Roth.
Yeah.
IRA,
You'll pay the taxes on it initially when you switch it, but then no more taxes ever again.
But you can still have your contributions
Yes.
added to it.
Yes. But they're
Oh.
pre-tax.
So everything is free when you like.
Yes.
Whatever money
You don't even pay taxes on the interest on that, on a Roth IRA. You can contribute up to 100% of your earned income. Like I say, it's up to $6,000 unless you're over 50, and then you can do 7,000.
Not even on the investment.
Not on any of it, on a Roth. No more taxes. You've already paid that. Yes, you can.
You can.
You can convert your 401k to a Roth. My son's 401k is a Roth.
Easy.
Yeah, it's easy. Yeah, contributions are made with after-tax dollars on a Roth, and the qualified distributions cannot begin until the account is open for at least 5 years and the owner is 59 and a half. So if you want to take it out at 5 years to make a down payment on your house, a first home, or to send your child to college, you can do that without any penalties. Okay, but otherwise you wait till you're 59 and a half or you get the 10% penalty, right? So that's how that works. But you can keep it in there for as long as you want. You don't got to start taking it out anytime. There's no rules.
But then 10% is way cheaper than having the tax back when you get the phone.
Exactly.
So
Yeah.
it's way better.
Ah, you got a brain. Amazing, huh? So, yep. Business insurance. Business insurance is really fun. Businesses can purchase life insurance as an employee benefit or as a way to protect themselves against a death of a valuable employee. A key person is a way a business can use life insurance to protect the business against financial loss if one of its most valuable employees dies. My husband is an MVP. He's the building official for the city of Santa Cruz. He does the work of like between 4 and 6 people at any given time. He does not have a full staff because COVID, everybody quit, right? Or didn't come back. And he works his butt off. But if they lost him, they'd be up a creek. So they have a fat insurance policy on him because they know they're going to have to hire 6 people in his place. Right? So that's key person. The business is the payer, the policy owner, and the beneficiary. So all they had to do is get his permission, say, hey, we're going to take this policy out on you. And he had to sign that as a provision of getting his contract, right? So, yeah. Buy-sell funding is for partners. So if you see more than one name on a building, it says and company or and sons or and associates, you know it's a partnership, right? More than one person owns the business. You can walk into their business and say, hey, I'd like to compete for your benefits package if you have your securities license, right? And they'll say, oh, what do you have? We'll say, well, more importantly is what do you have, right? So your partners, who are your partners? And they'll tell you usually 1 or 2 people and say, okay, if one thing was, anything bad was to happen to either one of them, are you okay with working with their spouse? And they're going to think on that, right? If they're not okay with it, they need to have a buy-sell agreement. And you can write that. just by writing the policy with the multiple names on. It's very fun, and they keep them for like ever. Especially because ours are so much less expensive than, whole life ones. And we can also write their investments for their company as well. And we can write it where they don't even have to pay except for the $75 a year maintenance fee, right? They love that when you can do that for them. I write a lot of businesses. It's really fun. When you write somebody's 401k, then you can go and write all their employees separately as well. They're fun. And when you do it, all you do is you have this questionnaire. You take the HR department, right? You give them the questionnaire, they fill it out, you send it in the home office. Home office will send back a hardbound portfolio with everything in it. And you're going to go, what do I do with that, right? You set up a conference call with the home office and the employer, and the home office explains it all. All you do is collect the signatures and get paid forever and ever. It's awesome. Yeah. It's way fun.
And how much are we talking about?
Depends how big the company is, right? My minimum monthly from any one company is $3.25, and I've written several companies. So yeah, it's fun. Social Security benefits, also called old age and survivor's disability, that you need to know. Old age and survivor's disability, OASDI. It uses a quarter of coverage system to determine qualification for Social Security benefits. Fully insured is 40 quarters. Fully and 40 go together. That's easy, right? Current goes with 6. Currently has 6 quarters of coverage or credits during the previous 13-quarter period, ending the quarter the individual dies or becomes eligible for benefits and qualifies for limited benefits. So current is 6, fully is 40. 40 is 10 years, right? Just so you know, in case they decide to put 10 years instead of 40. Here's the mix. We talked about those a minute earlier. 7 pay test, a whole life policy in which the premiums paid during the first 7 years of the policy must not exceed the total amount of net level premium that would be required to pay the policy up. Any policy that fails the 7 pay, that's the key words, fails the 7 pay. You see that, you know what's your answer. Or if fail 7 pay is in the question, you know MEC or modified endowment contract is your answer. They go together all the time, right? Make it easy. Once a policy becomes a MEC, it remains a MEC. It cannot change back. So a lot of people used to go buy these fat insurance policies if they got a lump sum of money and they didn't want to pay taxes on it. And so they got wise to that and said, nope, if it doesn't meet these conditions, sorry, you're paying your taxes, right? Government wants their cut every time, don't they? I hope that goes away. It could, it could. Okay, if you want this graphic, help yourself. I'm not reading it because my voice is wearing out. Okay. When someone other than the insured is the owner of a life insurance policy, this is called, look at you, third party is correct. Which of the following is not a requirement of group life conversion? Thank you. Yep, no proof of insurability. When a group plan is contributory, how many must participate? 75 is correct. Best answer, good job. Buying a policy to offset a financial loss in the event of a valuable employee's death is called what? Key person, yes. All the following requirements are correct about qualifying retirement plans, except except though. See. Remember, gotta look at except, right? It says they don't qualify for special federal tax treatment. Of course they do. That's the whole purpose of it, right? 10% penalty must be paid on withdrawals prior to what age? 59 and a half. That's correct. Traditional IRAs require distribution of benefits by what age? 72. Whole life policy in which the cash value builds faster than a 7-pay is called a what? Modified endowment contract, or a MEC. Death benefits paid to beneficiary are tax-free, yay. If the cash value exceeds the premiums paid in a whole life policy, what are the tax consequences if surrendered? The portion that exceeds the premiums paid is taxable, right? That's interest.
Is that what we figure out? If it's only lump sum, that it's tax-free, but if that goes monthly.
Correct. Yes. And the total amount received when the policy is surrendered is taxable. The interest earned is taxable, and the cash value is taxable, right? So, what a bunch of nonsense they put there. If you ever get a question and it has an option of all the above, just mark it, because 9 times out of 10 it's the right answer, right? Don't even care about this. Dividends paid by participating life policy are what? Dividends are tax-free. Tax-free. Dividends are not taxable because you already paid taxes on them. Which of the following is not true about qualified retirement plans? They can only be offered to company officers. That's not true, right? They're for all the employees. What does the viator receive when selling a policy to a provider? A percentage, right? So, you know, when you see percentage, just mark it, right? All right, we're almost there, guys. We're getting through it. Insurance regulations. This is a review of general state insurance regulations covered on the Pearson VUE Life licensing exam. Awesome. Insurance contract is an agreement between a policy owner, often an insured, and an insurer, where the insurer agrees for consideration. What's consideration? Premium for a promise, right? Remember that. Premium for a promise to indemnify. What's indemnify mean? To restore or make whole, right? So if I went out and crashed a little Toyota, I couldn't expect the insurance company to come around and buy me a Bentley, right? Going to get another Toyota if I'm lucky. That's indemnify, to restore or make whole. Insurance transaction, that's the solicitation, inducement, negotiations, effectuation, or execution of insurance contracts and transactions of matters arising out of the effectuation of contracts. If you are transacting insurance without a license, you are breaking the law. So you're not allowed to go ask people if they want to buy life insurance right now, right? You can let your upline do that, but you could sure ask them, you know, if they give you an hour of their time to help you get trained for your business, right? You can always do that. If you say, hey, could you help me out with an hour of your time? Most people are going to say yes, right? Make it simple, but don't get yourself in trouble, right? So that's an insurance transaction. Insurance code, the state insurance law written and put into force by the state legislature. So not by the commissioner, the legislature, a body of people, right? A producer is a person licensed to sell, solicit, and negotiate insurance. And a certificate of authority is the license issued by the Department of Insurance, the DOI. You'll learn all these things and you do it long enough, right? The Department of Insurance that authorizes an insurer to transact insurance in that state. Every state or territory has a department or division of insurance to oversee insurance business. The chief executive and administrative officer of the state insurance department is the commissioner. In some states, they call them a director or a superintendent, but they do the same job, right? For this review for California, we're going to use commissioner, right? The commissioner may be either elected by the general public or appointed by the governor. The length of the commissioner's term is set forth in the insurance code. In California, they get 4 years and they're elected by the people, just like the president, right? In Maryland, no. Maryland, I think they're appointed by the governor. They still get their 4 years, but they're appointed by the governor. So it's different in different states. So if you're watching this from another state, please check your state laws, and it'll be in your practice exam and tell you if it's right or wrong. Just guess and it'll tell you the right answer, right? That's all you got to do when you're practicing those things. Just guess. If it tells you the right answer, then you learn the right answer, you go do it again. It's okay, right? Just practice. So consult your online course or your webinar for your state-specific items and details. The powers and duties of the commissioner, they oversee the operation of the department. They carry out and enforce the provisions of the code. They do not write laws, they enforce the laws, right? They make reasonable rules and regulations to carry out the insurance code. They issue licenses and certificates of authority. They conduct examinations and investigations of insurers. They approve policy and contract forms. They protect the public interest. They do not write insurance laws or set premium rates, right? The insurers do that. Hearings, orders, and penalties. Every state is different on these, so please check your online things that tell you your actual laws. The commissioner can conduct investigations and hold hearings when needed and or requested. A notice of hearing must be given, including the time and location of the hearing, according to a time frame set forth in the code. So even here in California, you're going to have to check on your practice exams or on your quizzes and find out, are we 3 years? Are we 30 days? How much time is required for notice of hearing, right? Because some states are 3 days, some states are 7, some are 10. So check for your state. If after a hearing, the commissioner finds that a person or company has conducted an unfair trade or marketing practice, the commissioner can issue a cease and desist. And believe me, you do not want that to happen, right? I had a cease and desist once. This idiot guy that wanted me to date him and I refused because he was an alcoholic. He called up one of my clients and said I was doing fraudulent business. I was doing a $750,000 deal with that client. They called up the home office and say, you know, somebody called and said that this person's doing fraudulent business. They put me on a cease and desist. The SEC called me up and said, Paula, and I'm like, yeah. I said, this is a cease and desist order. You are out of business as of this moment. And I'm like, what? Excuse me? Well, this guy, he used to leave messages on my answering machine. And on one of those messages, he said he was going to do that. So, and back then is when we had the little micro cassette tapes on the answering machine. You guys don't know what those are. Huh? But I had it. And so I told the gal on the phone, I said, I have this tape where he says he's going to do that. She said, you have it right now? I said, it's in my hand. I had a knock on my door right while I was still on the phone where the freaking FBI was outside my door. And they took the tape instead of taking me. They were going to cuff me and take me out. Yeah. So you don't want to cease and desist. It took a full year for them to finish my background check and give me my licenses back. Yeah. So I always tell my recruits, never lie, cheat, or steal, right? If there's anything in your background, even if it's been sealed, tell us now. And let's find all the proof we need and submit that with your application, right? And write a letter as to just what happened and why. Because if you do that, you're going to save yourself a world of time, right? It's not that they're not going to let them hire on, right? They just need to know the circumstances. We have a great legal department. Peter Schneider, the president of our company, he's a big time attorney. He knows all this stuff and what to do about it. So anything they can't figure out in our legal department, Peter gets it and he's like, oh, you do this, right? So anytime you have any legal problem at all, if you had a DUI or something, you could call the home office and say, look, I got this DUI, I need some help. And they will put you in touch with people that will help you, right? They're amazing that way. So the commissioner may also levy a monetary penalty against a producer or insurer. Oh, by the way, that guy that did that to me, he got prosecuted. So, yeah. Licensing requirements, qualifications to obtain a resident producer license. You must be 18, submit an application, pay the licensing fee, complete your pre-licensing if required in your state, pass your examination, have not committed any act that is grounds for denial or revocation of the license within the last 5 years, right? So that means did what you did, you know, if you got a misdemeanor or even a felony, did it have anything to do with money? That's probably going to be what they base their decision on. So please consult your life insurance manual for state-specific licensing requirements. A resident is a person licensed as a producer in the same state in which he or she is a legal resident. Right now, you all are trying to get a resident license in the state where you're at, right? If you want to do business in another state, say like I'm licensed in like 7 different states, you just pay a fee and they give you your license. I've not yet run across any state that made me take a test. So you just pay the fee. Some states require really ridiculous fees like Illinois. So Illinois can keep it, I don't care. But yeah, but most of them is pretty reasonable. Okay. You cannot write securities in any state where you're not licensed as well. Be very careful when you get your securities. Okay. So make sure you know the rules. Ask somebody. If you don't know anybody that knows the answers, you can call me up. I don't care. Right. So a temporary license is issued for a specific length of time for the continuation of an insurance business to the spouse of a deceased or disabled producer, the employee of a business entity upon the death, disability, or termination of the designated licensed individual, to the designee of a producer entering active military service, or any other circumstance the commissioner deems necessary. Not a retiring producer. That's the one that doesn't belong. Okay. Persons who do not receive any commissions are exempt from having to obtain a license. Examples include persons who perform executive, administrative, managerial, or clerical duties, technical advice and assistance to licensed producers, rating or classification of risks, advertising duties, counsel or advice for an employer. So they do not. A person who solicits does. Okay. So when you're doing this question, you're looking for the word solicits. That's the one that you want. Right. A producer must be appointed by an insurer before acting as an agent of that insurer. You have to be appointed. So just because you pass your test, you got to wait for the letter from the company that says you're appointed. They usually put it right smack on your homepage. Congratulations, you're appointed. They used to put it in the emails, but so many people just didn't check their email. Right. So they put it right on your homepage. You're appointed. Congratulations. So the commissioner will verify that the producer is eligible for the appointment. And you guys, if you take your exam and you're not appointed within 14 days, check in with the home office and find out what's taken, right? It might be the state that's slowing them down. California, they're way slow since COVID especially. So I'd keep calling RLC. My license hit yet? My license hit yet, right? When I had quit for 6 years and I came back to California, I was in Arizona and I had my life license still, but I didn't have, they failed to file my securities, even though I had paid for it. So I lost all my securities license. I had to take them all over again. And when I got back, I was waiting to write my dentist that $2 million policy. So I called up home office and I'm like, you know, how long is this going to take? I just passed my exam yesterday that, you know, my dentist wants me to write it. And they just pushed the button and said, there you go, go write it. I'm like, thank you. Because I know people in the home office, a lot of them. So, you know, I've been around a long time. When I quit, I wrote them a letter saying I was, you know, resigning after 22 years. And when I came back to California, I called them up to see what I needed to do to come back. And they're like, Paula? And I'm like, yeah. They said, baby, where have you been? And I wrote you a letter. They said, oh, honey, we threw that away. Like, who does that, right? It's too funny. But anyways, you got to go through all these things. You got to get your appointment. The commissioner will verify that you're eligible. And if you're ineligible, if they find something in your background that you did not disclose, even if it was sealed, you have to disclose it, right? If you lied on your application at all, you're done, right? It's so important. Tell everybody, tell the truth, the whole truth, all of it. The insurers must also notify the commissioner of appointments or terminations after the producer has been terminated. Again, check your state rules, right? License renewals. A producer's license remains in effect unless it's revoked, suspended, or not renewed. Producer's licenses must be renewed and your continuing ed completed on a regular basis in most states. This is every 2 or 3 years. The more you do it, the easier it gets. It says it's 24 hours, but it's credit hours, not button the chair hours, okay? It's open book. So you can just go through and find the answers. And usually I use the Success CE. They'll highlight what's going to be your questions on your exam. And the text. So you can just go through and find the highlighted stuff and just answer. I know it all now because I've been doing it for forever. So last time I did it, I just went through every single one they offered and just did all the tests. I didn't even open the books, and I got 68 credit hours, which I've been able to carry over all the time. All I got to do now is my ethics, which are 3 hours, and I can do that in like 5 minutes. So yeah, but it's fun. And the more, like I say, the more you do it, the more you know. It's easy. So your CE licensees must complete a specific number of continuing education hours each renewal period. In California, every 2 years. In some states, the required hours include a specific number of hours in ethics. Ours requires 3 hours every licensing period. So, and like I said, it's not button the chair hours, it's credit hours. So change of name or address, I always say immediately, because if you forget at the end of 30 days, you're in trouble. Right? So as soon as you know your new address and you're getting moved in there, you want to get online and change your address with the Department of Insurance. Most states require the change to be reported within 30 days. That's the law. So for the test purposes, it's 30 days. But if it says immediately, take immediately, right? Administrative actions. Producers must notify the commissioner of any administrative action taken against them by another government agency or in another jurisdiction within a set period of time. So like I said, if any legal issues come up in your life, not a divorce, they don't care about that. But if you're prosecuted or have a lien or any kind of problem like that, you just call up the home office and ask to talk to compliance, and you tell them what's going on, and they will get you to the right person who's going to help you. Don't put it off, because if you put it off, you'll be in a world of hurt. I had a felony arrest. Yeah, me. I will. My stupid late husband's brother, I offered him 50% of my husband's estate because we didn't have the will done. We were only married 2 months, right? So I said, you can have half of everything. Let's just do that. And he's like, no, I want it all. And so he sued me. And the judge says, she offered you half. She's his wife. Said, so she'll get 75%, you'll get 25%, right? He went to another judge and got it reversed, where I got 25% of his estate and all the bills. And I had to write him a fat check right then and there. I'd have been held in contempt of court. So I wrote him the check and I said, don't cash this for 2 days till I can get back down to my house and transfer the money. He went straight to the bank and then to the sheriff's office and had a warrant sworn for me. 150 grand. I had to come up with that like right now. So, I mean, I had it. The DA, she called me up and said, Paula, what's this? I'm like, yeah, well, I told her what happened. And she said, you have the money? And I said, of course I do. And she said, can you just bring us in a certified check and we'll let this go? And I said, well, yeah, of course. So I got the check and I took it in, I gave it to the court and they dismissed it. But still, it showed as a felony arrest. They didn't book me, but the arrest happened on paper. So I called home office. They said, do you have everything you need? I said, yeah. And I told them what the DA said. They said, good. So you just write us the letter of everything that happened and then the final paperwork from the court that it was dismissed and you're fine. Great. But every time I do a securities license, like the 65 and this 26, all that, I had to do it all over again. So you have to keep your paperwork, really important, right? So yeah, you don't want to have that concept, but the home office is awesome at helping you with anything you need. They really are. That's what they're there for. They support us, right? So the requirement for reporting administrative actions is usually 30 days. If it's after that, you'll be getting in real trouble, right? So don't sit and cry about it and worry about it. Just call the home office and say, this is what's going on. What do I do? Right? If you really messed up and it cost you your license, well, it's better than going to jail, right? So the commissioner can suspend, revoke, refuse to issue or renew a producer's license and charge a penalty for providing incorrect or untrue information on a license application, withholding, misappropriating, or converting for personal use any money belonging to insurers or others in the course of insurance business, having a license suspended or revoked by any other state, being convicted of a felony, no matter what it is. It's up to the commissioner whether they're going to allow you to work or not. Transacting insurance business with a person who is not licensed, you don't ever do that. Forging another person's name, don't do that, especially on these electronic applications, right? You make sure you transfer that screen to your client and let them, if you're doing it on Zoom, let them sign their own name, put in their own initials or the last four of their social, whatever is required. You do not do that for them. They can take your license for that. Intentionally misrepresenting the terms of an insurance policy. We don't have to lie. We have good stuff, right? And we don't have to talk bad about the other companies. Like I said, I just show them the policy. You know, can you read this and tell me how you best understand it? You're not telling them nothing, right? That keeps you out of trouble. Failing to comply with a court order imposing child support, that can get you in trouble. And failing to pay state income tax can get you in trouble. You have to have a good business reputation, good integrity, right? Always never lie, cheat, or steal. Remember that. Fiduciary responsibility is a producer who handles insurers' funds in a trust capacity. Premiums received must be kept in a separate account, not commingled with your own personal account. So fiduciary, and you're going to look for premiums more than likely, right? But trust capacity is the other one they like to use. So commissions, no insurer may pay a commission fee or other consideration to a person that is not properly licensed. That's why we're building up bonuses for you guys. It's not commission. If it's commission, you'd have been paid a whole lot more, right? That's why you want to hurry up and pass this dumb test, right? So you can sign your own and get your commissions. Commissions are awesome. They really are. When I started this business, I knew I needed a new car. So I sat down and I figured out, okay, I can make this much money in 2 hours every week, 6 months. I got my new car by my commissions. I determined what I made. So no, an insurer producer may not share commissions with anyone who is not licensed in the same line of business. So you can share your insurance commissions or whatever commissions you want, as long as they have the same license as you do, right? So if somebody goes and writes a sale for you and you want to share it, you both sign it, right? If it's your client, like I did a lot because I was working most of the time and I set 5 appointments. I could only run 2 of those in 2 hours, sometimes only 1 of them. So I had to call somebody else to do it. Then I just sign on it as a share. It worked. So unfair trade practices are boycotting, coercion, intimidation, defamation, unfair discrimination, misrepresentation, false advertising, rebating, controlling business, twisting, churning, and unfair claim settlements. So you can go ahead and take screenshots of these if you want. Boycotting and coercion is illegal to be involved in any activity of boycott, coercion, intimidation that is intended to restrict fair trade or create a monopoly in the insurance business. Coercion is to require that as a condition for a loan, the applicant purchase insurance from a specific insurer. So if you want to get like credit life insurance on your loan, say like you're going to buy furniture or something that's going to cost you over $5,000 and you want to get insurance on it, I don't recommend you do that. If you have life insurance, you don't need it. But anyways, if they say you have to buy it from our insurer, no, you don't. That's called coercion. Right? You can buy it from anybody you want. Usually theirs is relatively cheap. They've got to deal with them. So not a bad thing. But if they say you have to or you can't get the loan, that's illegal. Defamation occurs when an oral or written statement is made that is intended to injure a person engaged in the insurance business. It also applies to statements that are maliciously critical of the financial condition of any person or a company. Every insurer is required to have so much reserves, right? It's the law. So you can't say, you know, this company is going to go under tomorrow. That's not fair. It's not allowed. They used to say that about us all the time when I was brand new in the business. Heck, Art Williams even said a lot of times he wasn't sure if we're going to be in business tomorrow. But, you know, look at us now. We're the biggest out there pretty much. So you don't talk bad about other companies. It's not necessary, right? Keep your opinions to yourself about that sort of thing. Unfair discrimination. Obviously, guys, it's unfair, illegal to discriminate in rates, premiums, or policy benefits to persons within the same class or life expectancy. No discrimination can be made based on marital status, race, national origin, gender identity, sexual orientation, creed, or ancestry, unless it's made for a business purpose or required by law. Like men die before women. So you can discriminate. Women can pay lower rates than men, right? Because we live longer. You can't discriminate on marital status or race. What's that got to do with anything, right? Nothing. So, but that's how that is. Somebody's in my chat. Okay. Yeah, go away. Where'd my arrow go? There it is. Okay, misrepresentation is making verbal or written statements about a policy's terms or benefits that are false, misleading, or deceptive. It's when the agent lies, right? So misrepresentation, agent lies. Just don't do it. Never lie, cheat, or steal. False advertising must be accurate and cannot contain statements that are untrue, misleading, or deceptive. So if you see anything about marketing or advertising, you know, it's false advertising they're looking for, right? Rebating. This one still confuses me, and I've been in business 36 years. Okay, any inducement offered in the sale of insurance products that is not specified in the policy. This includes rebates of premiums paid, special favors or services, advantages and dividends or other benefits, stocks, bonds, securities, and their dividends or profits. Both the offer and the acceptance of rebates are illegal. What the heck? It's not where I meant to be. Controlled business, writing business on one's own life, your immediate family or business associates. Most states limit the amount of controlled business a producer can write to 20% or less of what you're writing. So if you got 80 people in your family, you got to have to call the home office if you want to write them all, right? Say, you know, look, these are my cousins, these are my aunts and my uncles, whatever. And, you know, they want me to be their agent. They'll tell you yes or no, right? They're going to look at the kind of business you're writing and see where you're at. So as long as you're writing good business and they're not all lapsing like within the first 60 days or the first year to try and just get you commissions, you know, they're likely to say, okay. Twisting is a misrepresentation, a lie, right? Incomplete or fraudulent comparison of insurance policies that persuades an owner insured to his or her detriment to cancel, lapse, switch policies, or take out a policy with another insurer to their detriment. Twisting is usually the words induce, lapse, or forfeit, or the client's detriment, right? That's twisting. Churning is replacing policies for the sole purpose of making commissions by using policy values to purchase a new policy with the same insurer. I once had a client who had 25 policies on her 4 kids. She had paid more into them than they ever were going to be worth. Yeah, that was churning, just to get extra commissions. Unfair practices in claim settlement committed frequently enough by insurers to be considered a general business practice include misrepresenting pertinent facts or policy provisions relating to the coverage, failure to acknowledge and act promptly on written or oral communications about a claim, failing to adopt and implement standards for investigation processing of claims, failing to affirm or deny coverage of claims within a reasonable time after proof of loss is submitted, refusing to pay a claim without investigating all information and explaining the reasons for denying the claim or offering a compromise settlement. That's a test one right there. Not attempting to promptly and fairly settle claims when liability has become reasonably clear. That's often on the test also. And compelling insureds to initiate lawsuits to recover amounts due under an insurance policy by offering substantially less than the amount ultimately recovered under these suits. That's often on the test as well. Any one of those 3 would be an answer. Okay. Advertising includes everything from print ads in newspapers, magazines, broadcasting, commercial on television or the internet. Even your business card can be considered an advertisement. It must be accurate, not misrepresent the facts. The insurer whose policies are being advertised is responsible for all its advertisements, regardless of who wrote, created, presented, or distributed them. The form and content of all advertisements must be clear enough to avoid deception, and it must be approved by a home office. So don't go posting TikTok videos and stuff without having it put through compliance first, or you could be fined like $2,500 or lose your license, right? I've seen several people that were trying to recruit on TikTok and it was illegal, and they still haven't pulled their videos down. You can recruit, but you can't just do a TikTok video and put anything you want in it. You can't say words like I'm hiring. There's certain ads you can and cannot use. We have a whole book full of them. So between the thousands that are in there, you can probably find something that you want to post. You run that through your RVP, say, look, I want to put this on TikTok. Is that okay? And they'll say sure or no, right? And they'll tell you why, right? You do, because you have to put certain information on there by law, right? You have to have your RVP's name and office address and phone number. That's required. If you're not doing that, you could be in trouble, right? So the form and content of all ads must be clear enough to avoid deception. Files of all advertisements must be maintained by the insurer for the length that is specified in the code. See, the home office has to have a copy of it. It has to be in their files for like 5 years. So the Guarantee Association is created as a nonprofit legal entity. You guys are familiar with the FDIC, right? For the banks, they'll pay up to $250,000 per client account. Well, insurance works the same way. We're just not allowed to talk about it. You can't go and say it to your clients unless they specifically ask you, am I insured? Then you can say, yes, we do have a Guarantee Association, right? But to go say, oh, and we're guaranteed like the FDIC, no, we can't do that. I think it's crazy, but it's true. So it's an unfair trade practice to make any statement that insurance policies are guaranteed by the existence of that Guarantee Association. Replacement, any transaction in which a new life policy or annuity be purchased and is known or should be known that it will be taking place of an existing policy or annuity. The existing insurer, the company whose policy is being replaced, and the replacing insurer is the company that issues the new policy. Both the applicant and the producer should sign a notice regarding replacement. Each should retain a copy. Ours is all electronic now, so you just list all of them in there, and there's a drop down where it all shows you all the policies and their addresses. So you just find one that's on your policy and click it, and they'll take care of all the replacement stuff. It'll all be emailed to your client, and they'll take care of sending it to the other companies as well. You make sure you get that list of all the existing policies or annuities that are going to be replaced, and leave any brochures or sales material with your client, and submit a copy of the notice regarding replacement with the application to the replacing insurer. The company will take care of that as long as you do it electronically, right? If not, we do have paper copies that are done in triplicate. So the duties of replacing requires a list of all policies to be replaced, a copy of the signed notice regarding replacement from the producer, send each existing insurer the written communication advising the proposed replacement within a designated number of days. Usually it's like 3 days, I think. Notify the policy owners the right to return a policy within a specified number of days of delivery for a full refund, right? In replacement, it's 30 days. Maintain records of all written communication for a state mandated length. So look on your online thing, your practice exams, and it'll tell you how long it is, right? If you don't know, take a guess. It'll tell you, right? That's what I love about our practice exams. Just guess anything. It'll tell you the right answer. All you got to do is learn it, right? For the insurer, they must provide the policy owners with a policy summary within a set number of days receiving the written communication from the replacing insurer. Retain replacement notifications for a state mandated number of years or until the conclusion of the next regular exam by the Department of Insurance, whichever is later. So whichever is later is going to be your answer, right? Coverage written on the life of the debtor to pay off the balance of a loan in the event of a debtor's death, usually written as decreasing term. It can be in either individual or group. The creditor is the owner and beneficiary. That's important. The creditor is the owner and the beneficiary of the policy. The credit life cannot pay out more than the balance of the debt. Otherwise, they'd be insuring you for $1 million and knocking you off, right? The creditor can require that the debtor have life insurance. They cannot require that you buy it from a specific insurer. You can have it whoever you want. It's the producer's responsibility to make sure that the annuity transactions meet consumers' needs and financial objectives. Producers must make a reasonable effort to obtain relevant information from the consumer and evaluate their age, annual income, tax status, financial needs and timeline, their investment objectives, liquid needs and liquid net worth, existing assets, intended use of annuity, financial experience, and risk tolerance. You know, I'm going fast through this, right? I don't expect you to remember everything. You'll get enough to pass the exam, I promise. Okay, here's our last quiz, I think. Any person authorized to sell, solicitor, negotiate insurance is called a what? Yes. And a producer represents the insurer. Yes. An insurer licensed to conduct business in states other than the one in which it is incorporated is called foreign. Yes. Get you guys. What must an insurer obtain from the department to do business in a specific state? Authority. Yep. What type of license would a producer who is licensed in his home state need to get to conduct business in a neighboring state? Yes. An insurer who is not licensed to conduct business in a particular state is said to be non-admitted. Making oral or written statements that are maliciously critical of the financial condition of any person or company is defamation. Any inducement offered in the sale of insurance products that is not specified in a policy is called what? Rebating. Oh, you seemed a little iffy on that. Any inducement offered in the sale of insurance products that is not specified in a policy is rebating. That means you're offering something, like share your commission with them. You can go stay in my lake house, right? I'll give you tickets to the game, that kind of stuff, right? A producer who intentionally misleads a client by stating their policy will pay dividends is guilty of, they're lying. It's a misrepresentation, right? Broadcasting or telecasting any written or oral material that is untrue, deceptive, and misleading is called what? False advertising, absolutely. When a new policy is written to take the place of a policy that's already in force, it's called replacement. What document must be signed by the applicant and producer and a copy given to the applicant at time of application for policy replacement? Yes, the notice regarding replacement, right? Replacement in the question, replacement in the answer. Easy. Which statement correctly describes a fraternal benefit society? Looking for members, right? There you go. Social organization provides life and health insurance to its members. Which of the following is an example of producer's fiduciary responsibility? Look for premiums. Promptly forwarding premiums, right? Fiduciary and premiums. What nonprofit association protects the owners of policies issued by insurers that become insolvent? Guarantee Association. All the following are powers of the insurance commissioner, except, they don't write the laws. Which of the following persons would be required to be licensed as a producer? Good job. Soliciting. License may be denied, suspended, or revoked for any of the following reasons, except assisting a client, right? Nothing wrong with that. All the following are unfair claims practices, except denying a claim that's not covered, right? If it's not covered, you're not getting paid. And the form of insurance that usually funds credit life is what? Decreasing term. All right, you guys want to do the general terms? You want to get out of here? How are we doing on time? All right, we got 20 minutes. We can do it. Risk is the uncertainty of loss, right? Hazards increase the likelihood of a peril. A peril is the cause of a loss, right? Physical, moral, or morale hazards. I like to say morale hazards, right? That's usually driving under the influence. Driving too fast would be a morale hazard. Not caring about what kind of damage you do is also a morale hazard, right? Moral hazard means you lie. The client lies. It's a moral hazard. Physical hazard means like, oh, you left some spilled water on the floor and slipped in it, right? That's a physical hazard, right? Peril is the cause of a loss, a fire, accident, or sickness. Loss is a reduction in the quantity, quality, or value of something. Here's the star. Sharing, transfer, avoidance, retention, and reduction of risk. Sharing risk are pools of insurers with a common risk, like a bunch of tavern owners, right? They can get together and share their insurance costs. Transferring is the most common kind of handling your risk. You're going to transfer it to an insurance company by paying a premium, right? So that's the basic premise of insurance, is transferring risk. Avoidance is you're never going to fly because you're afraid the plane's going to crash. You're never going to drive a car. You're never going to go outside, right? You're just going to avoid it altogether. Stay in your little house. So avoiding risk. Retention means you're going to retain all or part of the risk. Like you have a high deductible. I have very high deductibles on my insurance. I pay at least minimum $1,000. My health insurance, I pay 30%, which probably wasn't the smartest thing for me, but It comes through my husband's work, so we just do that, right? And reduction of risk means you're going to do things like wear your seatbelt. You're going to have smoke detectors or, deadbolts on your house, things to reduce risk. If you want to reduce personal risk, you might, exercise on a regular basis and eat right, do that kind of thing, be healthy. That's reduction of risk. So you can share, transfer, avoid, retain, or retention, on reduce or reduction of risk. The star. The types of authority expressed is written in the contract, right? It's just like a warranty is written. Express authority is written in your contract. Implied is not. You must have the authority to do it, to conduct business like saliva kits or calling a paramedics, that sort of thing, submitting business applications, right? Apparent authority, you seem to have it because of certain actions. You have your business cards and your rate book so people believe you're an agent, even if you made them up your own self. And people have done that, believe me. So when Art Williams retired, a lot of people did that. They made up things that didn't belong, and he literally had a heart attack and left the business, sold the business, and went after and prosecuted all the people that did that. There's RVPs. He was paying 110% commissions, which is a lot, right? But so they were just making up people so that they could get more and more commissions and, rip them off. It's like, how could you do that to somebody that gave you so much, right? It was terrible. Okay, elements of insurable risk. They got to be predictable, not due to chance. Definite and measurable, like in a car accident. They know how much your car costs to replace. They know how much your medical bills are. It's definite and measurable. The loss must be significant, but not catastrophic. If you see catastrophic in your answers, just mark it. It's the answer, okay? Loss is random. The law of large numbers. The larger the group, the more accurate the prediction, or similar or homogeneous. They all mean similar, right? So law of large numbers, the group must be bigger to predict the losses better. Adverse selection, those that need insurance the most are going to buy the most, right? So probably people that think they're going to die soon are going to want to buy a whole bunch of insurance. If they're not found medically insurable, they're not going to get it. Reinsurance, insurers insuring insurers. Every insurance company has a reinsurer. It's the law. Ours, I'm guessing, would be AIG. I don't know. But I know we do a lot of business with them. So I'm guessing they're our reinsurer. So that means we pay them a premium. And if we should suffer a big catastrophic loss, like, 9/11 happened, right? Our company was the only one out there calling people up saying, hey, your person you lost was our client. You have a death claim coming. We did that, right? Other companies said, oh, we're not paying, right? It took like a judge to say, yes, you are. So reinsurance means that if there's a whole bunch of losses, like in the earthquakes even, that's a catastrophic loss, or those big fires we've been having, catastrophic losses. Other companies, because they'll come in and they will pay a portion of the things the claims that we have to pay out. And every single company does that. You have. Human life value approach looks at future earnings of the insured. They look at wages, inflation, years to retirement, and the time value of money. Whereas the needs approach looks at the future financial needs of the survivors, like post-mortem expenses, for a funeral, debt, emergency funds, education funds, retirement funds, and money you want to leave to charities or whatever, right? That's the needs approach. Usually if they're looking for the needs approach, they'll put needs in the question. So needs in the question, needs in the answer. They rarely put needs in the human life value, okay? Additional annuity topics. Annuities are not life insurance policies. They are sold by insurance companies, though. Annuities are a way of saving money, usually for retirement or education, as a systemic, that's the key word, systemic way of paying out a large sum of money, like a legal settlement or lottery winnings. Accumulation is putting the money in, paying in. Annuitization is taking the money out, or the payout, or liquidation, or converting to a stream of income. They use all those words, right? Money put into an annuity, the contributions grow tax deferred until they're taken out. There are different ways to classify annuities. The first way is by how the payments or the premiums are made, either single premium or flexible premium. Single premium, they're going to pay it all at one time. That's an immediate. They're going to take the money out before 12 months, right? That's single premium immediate. Flexible is a deferred annuity. Payments and into and out of will be made over a period of time. The flexible premiums can either be the same amount each month or they can vary from payment to payment. The third way to purchase an annuity is either fixed or variable. Fixed earns a minimum guaranteed fixed rate of return. The insurance company, the insurer, accepts the investment risk. Fixed and general go together. The money is held in the insurer's general account in a fixed annuity. In a variable, it's held in a separate account, right? It's different because the interest earned depends on the growth of the investment in stocks and mutual funds that the owner chooses. The money is held in the separate account by the insurer. The owner bears the investment risk with a variable annuity because you choose your own investments. Since variable annuities are securities products, you must have both a securities and your life license to sell them. I know it's a lot, huh? But I promise you at least half of it will sink in. You'll remember. Equity index annuities, fixed annuity with a guaranteed minimum interest rate, but aim for higher returns. So if you see index, they're aiming for a higher rate of return, right? And they're tied to a familiar index like the Standard & Poor's 500. Market value adjusted annuities, single premium deferred annuity with a guaranteed interest rate for a specific maturity period, usually 3 to 10 years. Your most confusing one about annuities, choose this, market value adjusted, right? Often they don't put it on the test, but other times they'll put it a couple times, right? So if the question is really confusing and that's one of your answers, choose it, right? Straight life benefit payments. Straight life payments for life stop at death. They don't go to any beneficiary. A refund life payments until death. Remainder goes in to the beneficiary in a lump sum or installments, whatever they choose. Life with period certain, we talked about. If they tell you the number of years, it's period certain, right? Joint life, payments to 2 or more. It stops on the first death. Joint always stops on the first death. No more payments after that, right? Joint and survivors, based on the lives of 2, the survivor can receive full or reduced amount. So they will do joint in half or joint in 2/3 survivor. If it does like that, then you're going to get the full benefit while you're both still alive, and the beneficiary will get 2/3 or half of what you're getting when you're both still alive. That's how that works. But it stops on the second death, right? Fixed period. Again, if they tell you the number of years, it's fixed period. The amount of payment will be based on the annuity value and the period of time. Pays whether the annuitant is living or not. If you choose it for 20 years and you die in 5, it's still going to go on for 15 more years to your beneficiary, right? A fixed amount, the payments are set for that amount until they're all gone. So again, if you died before the payment, the money's all gone, it's going to go into a beneficiary until it's all paid out. Okay, you can take a picture of this if you want. You got 2 seconds. I'm going to change it. It's just a graphic. We already talked about all the stuff. 3, 2, 1, go. All right, suitability. This is the most important thing in your whole business, suitability. Don't write something for somebody they don't need. If you have a client who's 57 years old and they have no children, no spouse, no bills, why are you writing them life insurance? It better be a small amount, pay for their death protection, right? Unless they tell you they want to leave some money to somebody specifically. Otherwise, you better be writing their investments, right? They need cash. They need savings, investments. So suitability can be assessed by evaluating the customer's age, income, financial needs and situation, risk tolerance, investment objectives, tax status, and then their intended use. Payout period of an annuity is called the what? Annuity period, yes. An annuity benefit is paid to and based on the life of the annuitant. Which of the following annuities would not have a beneficiary in the annuity period? Straight life. Good, you learned that. Awesome. An immediate annuity can only be purchased with what? single premium, right? All the following are characteristics of a fixed annuity, except benefits are paid in annuity units. What the heck is that? We never talked about annuity units, did we? All right. Okay. All the following are characteristics of a variable annuity, except B. The insurer assumes the investment risk. That's not true. SEPs, these things. This you can do, like, soon as you fully fund your Roth, you can do your SEP or a simple. Okay. So it's for self-employed pensions. Employer contributes to the employee's individual retirement account, which has higher contribution limits than a traditional IRA. You can put a buttload of money in these things, right? Same in the simple for employers with no more than 100 employees. So you do a simple because you're not going to have employees at all, right? You're self-employed. The taxes are deferred and you still can put a whole bunch more money in. A 401k is a salary reduction plan with matching employer contributions. Profit sharing is for company profits. They're contributed to the plan and shared with the employees. And a TSA or 403Bs are for nonprofits like schools, churches, police, fire, those kind of people need a 403B. We can write those, right? In fact, they're pretty fun. Which plan allows employees to contribute pre-tax dollars and the company matches? Yes. Come on. Change. Which plan is only for nonprofits? 403B. Good. Maximum number of employees on a simple? 100. All right. We are done. We did it. You guys have been awesome. Are you excited? Do you feel like you've learned anything? Yeah. You ready to go take that exam? You take that exam this week, I bet you pass. From everything you got here, if you do this and the cheat sheets, you're good. Okay? That was a long session. 3.5 hours. You guys did good. Okay, y'all. Anybody that's on there, thanks for being here. Appreciate you. If you have any questions, you can unmute and ask me right now. We're all good? Everybody's fine? Then I'm going to go ahead and end it. Have a great rest of your weekend. Happy Mother's Day to all of you moms. See you next time.